Let's start. We were on the portfolio. Let's I think we have couple of questions left. Let's try 81 as a warm-up exercise. Let's try 81 as a warm-up exercise. It is based on systematic and unsystematic risk. Try question number 81. I'll just read out with you. Following are the risk and return estimates for two stocks. Stock you have expected returns, you have beta. Specific standard deviation of the expected return is available. A and B you have 14, 18%, 0.8, 1.2, 35 and 45. The market index has standard deviation of 25. Risk-free treasury bill is 6%. Specific standard deviation is nothing but unsystematic risk. This is unsystematic risk you have. And they've written very clearly percentage. You have to calculate standard deviation of expected returns of A and B. You know what you have to find? Standard deviation is nothing but total risk of A and total risk of B. So total risk would be equal to systematic and unsystematic. I'll just help you out with one part. Second part you can calculate on your own. Now, how do you calculate systematic risk formula? Okay, it's a beta square of A into standard deviation square market. Beta square is 0.8 to the power 2 into what? The standard deviation is 25. How much do we get? How much? 400. The unsystematic risk of A would be equal to, it's 35% given, so 35 square. 1,225. So if I find total risk of A, that is equal to standard deviation square of A, is 400 plus 1,225, 1625. Since he is asking standard deviation of A, that would be 1625 under root 40.31. 40.31. Try for B now quickly please, and then look at the second part. Try for B. So for B, when you calculate, same way it will be there. I think that comes 1.2 square into 1.2 square into 25% square. That gives you systematic risk 900. Unsystematic would be 45% square. That gives you 45 square. And I think since he's asking standard deviation, you leave your answer here. That's first part. So maybe another name, specific standard deviation, could be used for unsystematic risk, this word. And residual variance also we have learned, so be careful about these terms. Then he says, suppose a portfolio is constructed with the proportions of 25%, 40 and 35% in A, B and treasury bills respectively. A, B and treasury bills respectively. What would be the expected return, standard deviation and expected return of the portfolio? So what would be the expected return and standard deviation of expected return of portfolio? That means we have to find expected return of a portfolio. So expected return of a portfolio would be equal to what? You have expected return of the portfolio. What you have to include? Risk free. Risk free is what? 6. So this is 14, 18, 6. Weight is 25, 40 and 35. Weight is 25, 40 and 35. So I have 25 weight, 14. It's A, I think. 40 into 18 is B. 35 into 6 is C. That gives this. And since we have to find systematic risk of a portfolio, let's find beta of a portfolio. And when you're writing beta of a portfolio, be careful please. Risk free is also there, but risk free has what here? 0. Since risk free has 0, it will be 0.8 into 14 plus what? 1.2 into 18 plus 0 into whatever the weight comes out. Portfolio beta, how much do we get? Point 0.68. So if beta of the portfolio is 0.68, then we can have systematic risk of portfolio. It will be 0.68 square. Let's put in the square form first. Then since he is asking standard deviation, we will calculate standard deviation separately. 0.68 square into what? 25 to the power 2. To 89, 289 complete number, 289. This is first number. And then we have, sir, what? Then we have unsystematic risk, na? So it will be careful now. If you recall back in the previous class, we were doing one question 66, I think. 35 to the power 2 into into 0.25 to the power 2. So 45 to the power 2 into 0.4 to the power 2. So you will calculate this weight square, unsystematic risk square, weight square, unsystematic. Third would be 0. So you will get this as unsystematic. 289 plus 400.56. That's total square form, and I think it will get 26.26. Quickly check your numbers once. Quickly check your numbers. Done. This was just a warm-up exercise. Just quickly check it out once, please. Done. Now if you're done, we'll move to the portfolio rebalancing. In fact, one question I gave you as homework, that also you can try quickly if you want. This question has come approximately 6-7 times or 8 times in the exam. And the way they have done it, do exactly the same way. No modification to be done from your side, please. Nothing to be done from your side. Question number 36. It was a simple question. As an investment manager, you are given the following information. Investment in equity shares of Cement Limited, Steel Liquor Government of India, initial price, then you have dividends, market price at the end of the year, beta, and this is given Cement, Steel Liquor Government of India bonds. These are given. Risk free is given at 14%, and you are required to calculate the expected returns of the portfolios in each using CAPM. Actually, this model is based on, you have to assume it's a 4-factor model. That means 4-factor means basically the world has 4 assets. So based on that, depending on, since the world will have 4 type of assets, I think we have calculated our RM. So return of the market is basically calculated. This is the basic assumption of this. In the absence of any specific information regarding the RM, we have assumed return from given 4 securities is RM. Actually, RM is return from all risky assets in the world, and there is some thesis which is done. Since you have only 4 assets being given, and hence we use it, the 4 assets as this. Now, since they have given the beta of the Government of India bond, assume that, because maybe it's a riskier and that's why it is part of the RM. Do not try to challenge it out. This particular type of a question comes similarly same way. Since 1996 it has been coming till now. So exactly same we'll do. So RM would be cement, will be opening price, then closing price, difference of that, plus dividend. You'll get return 26.33. Then you can put down CAPM. In CAPM everything would be same, beta will be substituted. Substitute the beta of the each security, you'll get return of each. And then generally this question, when it has been solved, they have taken average beta for the purpose of portfolio return. It's not weighted average, but I think in the one of the lines they might have given somewhere that even if the student want to assume the weighted average, it's possibility. But whenever it has come, they have used only a normal average beta, because one question comes on the reverse calculation, in which you have to do the reverse calculation. So be careful in this. This question has repeated most repeated question I think of this chapter. So exactly same way we'll be doing it. Return from given securities, whatever given securities are, the return would be the RM, and based on that RM you can apply your CAPM formula. Based on CAPM, beta would be a variable. When beta is a variable, accordingly you can get some return out of it. And then average portfolio return is average of this, or you can calculate the average beta and calculate, substitute that beta and calculate return. Answer will come same. So when you're calculating reverse also, so they might write weighted average, but they use the simple average. You can go back whenever you're referring this, just see if they have changed to weighted average, change the question to the weighted average, else keep doing the same way, nothing to be changed. Most repeated question of this chapter. Let's quickly look at the numbers, then we move to portfolio rebalancing. Done. Let me move back to portfolio rebalancing now. Portfolio rebalancing. I'll just do a theory part with you and then we move to the practical of it. Portfolio rebalancing, 3 type of theories we can have. One is called buy and hold. Buy and hold means you buy and do nothing. constant mix, that means keep a same proportion, and then third is CPPI, constant proportion portfolio insurance. Now buy and hold, I'll just take a rough numbers to understand what it means is, do nothing, it means let's suppose total amount is 1 lakh, in equity invest 50,000, RF you invest 50, 1 lakh would be investment. The next day what happens, market decreases by 20, equity is 40,000 because equity will decrease by 20%, RF is still same 90, nothing to be done, leave your portfolio as it is. The next day what you have is market decreases by 10%, market increases by 10, equity value becomes 44, RF remains 40, so nothing happens here. It could be a possibility if the equity value becomes 0, still you have balance equal to RF. That's the buy and hold, first policy. Then constant mix, second one we have. In the constant mix what we do is, let's suppose amount you have 1 lakh, amount is 1 lakh, today you invest equally 50 and 50. The next day what happens is market decreases by 20%, let's suppose, and equity is declining exactly in the same proportion, it's assumption. So equity value declines 50,000, declined by 20%, it comes what? 40,000. RF is equal to what? 50,000. Then value becomes what? 90,000. The value becomes 90. Now in this case what happens? You have to rebalance. Rebalancing can be done as per the requirement of the question. He can say after 5 days, after 30 days, after 10 days, that he'll tell you. They'll rebalance accordingly, or they can set some parameter at this point of a time. We have to do the rebalancing. I am assuming rebalancing is done every time the balances move. So 90,000 you rebalance equity equal to what? 45 and 45. In this what will happen is, when the market has declined, you are selling risk free and equity value you are buying. Then when the market increases, that means if I look at here, let's suppose next day again the value would have declined, just a rough assumption. If the value would have declined, then the movement would have taken place again from the risk free to the equity. There could be a possibility market keeps declining and risk free becomes 0, equity value becomes 0, so portfolio value can become 0. That's the danger here. Now what I have assumed is, after first time rebalancing, next time when we are doing a rebalancing here, then before rebalancing 10% market increase, before rebalancing 45,000 value became 49,500, the RF was 45, total value became 94,500, and rebalancing was done equally. When the market is increasing, money is moving from equity to the risk free. Now in this case, sell equity and buy risk free, what you have. Now CPPI, this method, what is requirement from our side? CPPI is the equity is equal to multiplier into A minus F. A is nothing but amount to be invested in the equity. Multiplier, he'll give you the, depending on the safety margin, he'll suggest that what could be the floor value. Floor value is depends upon the risk aversion of the investor. For example, he says that keep my floor value at 75,000, keep my floor value at 80,000. So he wants his value to be maintained. So accordingly risk can be taken as per this formula. M is the multiplier, A is the asset value or investment value which comes out. Now I have assumed some number here. The numbers are, let's suppose A is 1 lakh, floor value 75, M is 2. Then the investment in the equity would be M into A minus F, that's 2 into 1 lakh minus 75,000. Equity investment would be equal to 50,000. That means you will invest balance in where? The risk free. So 0 period we have the combination of equity and risk free as 50,000 and 50,000. If the market declines next day, so before rebalancing, equity value is 40, the total asset value remains 90 because risk free is 50. New E would be equal to M, that is 2, which we have assumed 2 here. Asset value 90,000. Floor value is depending on your risk aversion, that means how much you are ready to take a risk. You want a safety margin of approximately 75, so it's a 75 comes here. The new equity value comes 30. It means in this case, in the falling market, money is moving from equity to risk free because he wants to safeguard his value. He does not want that the market keeps falling and his equity value becomes 0. So he wants to safeguard himself. Accordingly, he moves his value from equity to the risk free. And after rebalancing, what will happen is 30,000 equity, whereas before rebalancing it was 40. So 10,000 will move to what? Risk free. Now again, I think I have assumed decline just to prove that when it declines, the money will move from equity to the risk free. So 30,000 decline, I have assumed 20 percentage, new equity value 24, RF is 60, asset value becomes 84. So 84 is asset, I have 75 floor value. That means in this case my new equity value would be 18. Another 6,000 will move to the risk free. So that means in this case, as and when the market falls, the money would move from equity to the risk free. Whereas the danger of the constant mix was when the market was falling, money was moving from the risk free to the equity. And if it keeps falling, there could be a possibility value can become zero. In this, value will not become zero. That's why it's called kind of an insurance method. It's a portfolio insurance, what you have. So CPPI is the one which has been asked in exam, I think constant. So I'll take the example. Now how the floor value would be decided is, floor value one is he can give you exactly same way. Second he can give you is whatever the fall in the Nifty comes, exactly same level of fall I can expect from my value. For example, if Nifty can fall at the rate of a 10%, so you can expect that at the maximum you can expect 10% fall in your value of the portfolio. That means, for example, Nifty can fall 10%, and if I have a 3 lakh rupees of portfolio, then I can imagine a decline of maximum 30,000. That's 2,70,000 would be my floor value, depending on the question requirement. Otherwise, he will mention to you. Higher the floor value means you want to keep higher safety margin. You are risk averse. Now coming to the questions what we have on this. This came in the exam also, I think, and was part of RTP long time back. Question number 76. So we have question number 76. Just read out quickly, please. He says in the question number 76, Indra has a fund of rupees 3 lakh which she wants to invest in the share market with rebalancing target after every 10 days to start with for a period of 1 month from now. The present Nifty is 5326. The minimum Nifty within a month can at most be 4794.4. 4794.4. So 5326 can fall to 4793.4. How much it becomes? How much? 10 percentage. So it can fall by 10 percentage. She wants to know 10% means, that means your 3 lakh value you can expect to fall by 10 percentage. That means your floor value would be equal to 2,70,000. She wants to know as to how she should rebalance her portfolio under the following situations according to the theory of a constant proportion portfolio insurance policy using 2 as a multiplier. To immediate start with, let's do rough working, please. Answer I have given in the book also, I have given handout also. So in the book there could be a possibility, we'll cross check. It means as of rebalance to start with. So basically my equity value would be equal to M into what? A minus F. So M is 2. Asset value how much? Floor value 2,70,000. So what will be my equity investment? 0. 60,000. Very small number would come because floor value is very heavy. 60,000. Now what happens? First case is after 10 days, and she is saying she will balance after 10 days. The Nifty value is 15122.96. Started with what? 5326. Tell me the fall in Nifty, decrease in Nifty. 3.8. One more line I will show you. He says, for the sake of simplicity, assume value of equity component will change in tandem with that of Nifty. Let's suppose the question would have given beta. Let's suppose question would have given beta. Either he can ask you to calculate or what some other way. That means you would have then seen your fall would be equal to beta times into what? Market. We have done some question in the mutual fund also. When he uses Sharpe and trend ratio, he says the value will fall, market will fall this much. What will be the fall in the value? So accordingly, be careful. He has given, for the sake of simplicity, assume her equity component will change in tandem with that of Nifty, and the risk-free securities in which he is going to invest will have no beta. That anyhow we assume that the risk-free 0 beta. If beta was given, then your change would be beta times of the decline. In this case, if falls by 3.8, it means your equity value will fall by 3.8. So your equity value would be equal to 60,000 minus 3.8, 57,714, and risk free was same. Risk free was equal to 2,70,000. So your what would be your value before rebalancing? 2,97,714. So if I find my new E, because before rebalancing the equity value has fallen, accordingly my portfolio value has fallen, and if portfolio value has fallen, I have to rebalance. That means my new equity value would be equal to M, that is 2 into 297,714 minus 2,70,000. We'll get some number here. Equity value is how much? 60? 55,428. So if this is my equity value, my total value has to be 297,714. It means my risk-free value will be balancing figure here. My risk-free value would be a balancing figure here. 2,42,286. Try the next one, then I'll show you the answer, please. Now next what will happen is, this becomes your new A, this becomes your new E value. The next time what happens is, the market is increasing 5539. Accordingly your equity value will increase, accordingly your portfolio value will increase, and then you'll again calculate the new E value and shift. In this case you have shifted, since market has fallen, you have shifted your value from equity to risk free. If the market increases, you'll move your value from risk free to equity. Tell me the next answer once you calculate, and then I'll show you. Equity comes 64,430. Let me check out, please. This is solution number, actually. What was the question number? 70? It's portfolio rebalancing. So we had 3,53,226. It was 10%. Floor value was 2,70,000. Then to immediately start with, I started equity value is equal to M into A minus F. That came out 60,000. My value of portfolio is 60,000, 2,40,000, total 3 lakh. So we say Nifty after 10 days falls to 5122.96. Decrease in Nifty is equal to 3.81. Before rebalancing, my value was 297,714. New equity value is 55,428, and after rebalancing, this is what we exactly did. Second part, what you would have done, after another 10 days, Nifty value increases. Nifty increases by 8.12. That means my equity value will also increase by 8.12, 559,929, and my value of portfolio would be 302,215. 302,215. New equity investment would be equal to 64,430, and it means your money will shift now, sell RF and move to equity. So total would be this. So what happens is, before rebalancing, find out the value. Then you have to find what should be the equity value. Before rebalancing, your equity value was 59,929. After rebalancing, your equity value would be equal to 64,430, and you shift your money from the risk-free to equity. Fine. That was portfolio rebalancing. Now let me move to another question, which actually is a PhD level question. Came in 2007 or 8, repeated back some time ago. Yes. I'll discuss briefly now some theory with you, and then we move here. We have a concept of called corner portfolio. Actually, this is a technical name I can use, a corner portfolio. In simple word, I can use a linear equation or a critical line. Basically, whatever I'll be making will be a linear line, and linear equation, or I can even call it as a critical line. I'm not using a technical word. I want to keep my life very simple so that you understand what exactly we'll be doing. The equation would be, return of a security of Y would move in tandem with X based on some parameter. You will feel like this kind of equation you would have done. Now I'm trying to look at the return of a security. Let's suppose Y is a security. Movement in Y would be is equal to mx plus c. Mx plus c, that means X is a security, Y is a security, C is a constant number, M is a constant number. We'll try to find out what it is. We are trying to do a theory which is very technical in nature, if I say from the question perspective. But what I'll do with you is maths from maybe a 5th class or maybe a 4th class student also can do it. But problem is, in school we cannot win exam, in the IC exam you cannot do that way. Hence you have to do some these kind of a theory. You have to use these technical words, corner portfolio, linear equation, so etc. blah blah. Let me just put down some figures and tell me as per your common sense what happens. Let's suppose X data I give you. If you want to put, you can put your numbers, that's fine. Let's suppose X gives me 10% return and Y gives me 15, and I have X gives me 15, this gives me 25. Now it means what? If I general language, if I speak, X is moving by how much? 5. Y is moving by what? 10. How much time? 2 times. Now common sense wise, if I tell you, if I have a 18 here, what should be the number here? If I have a 18 here, what should be the number here? If this is 1, this is 2, this is third number. You've done puzzles sometime? This is what I was doing, and my son was able to do nalaik, but the next part he was not able to do. How much? 31. Exactly same way I'll do that question. When you go back home and see, that question would be very technical. Now problem is, if I write this way, no marks will be awarded to you. It's not your fault, because you have to use something. Let me now put down, look up please, what we do. If I use this equation, when I say Y is 15, M I don't know, X was what? 10, C I don't know. You'll feel like something, some line you have done, portfolio. Security market line null, go back and check. Kind of characteristic line, but when you go back, just try to figure out a constant number, something of that sort you would have done. But anyhow, let's not discuss on that. It was 15, 10, M into 10 plus C. Second time this became what? 25, M into what? 15 plus what? C. This gets cancelled. Minus 10 is equal to what? Minus 5M. M is equal to what? 2. Put m value in this part. Put m value in this. 15 is equal to what? M into what? 10. M into, no, M is 2 na? 2 into 10 plus C. Tell me how much C comes out? How much C? 5 or minus 5? Minus 5. Now let's try that if I am putting if x is equal to 18, then y would be equal to what, sir? 2 into 18 minus 5. How much do we get? 31. I hope you were getting 31. There was no need of this equation, and I'll show you in question also. Answer I would know, but I'll have to put this data, because unless and until you speak something very technical, the course looks very easy to you. Fourth part. Tell any number of your choice. Let's suppose 22. Any number. Tell me what number should come. 39. So as per you should come 39. Let's check by equation. If x is equal to 22, y is equal to what? 2 into 22 minus 5. How much do we get? 39. Very good. Copy that part. Then I'll show you what exactly the data we make. What we are doing, sir? You can write corner portfolio, linear equation, critical line. These are the equations, whatever way, and then we'll move to the data. If you say I'll directly use the data of the question, and if you want I can create an example. I'll directly use the data of the question, don't worry. Corner portfolio, actually this theory is based on minimum variance set. Will be using some data points, efficient frontier, etc. X is what here? Security. Y is also what? Security. Done. Now I am putting an example. I am taking an example in which I am putting some data points. I am putting, there is a portfolio X, portfolio X, portfolio Y. Actually this data I am using of the question only, so that the question would also be getting solved accordingly. There is weight of A, weight of B, and weight of C. We have 0.3, 0.2, 0.4, 0.5, 0.3, 0.3. Now first of all understand what does it mean. He wants to create, actually if you look at, I'll just read the data and then come back here. Investor has two portfolios to be on minimum variance set. Sir, what is minimum variance set? Which is lying on the efficient frontier. Now actually if I try to draw, just for a reference purpose, what happens is, you would have done slightly, I would have shown you in the beginning of the class. In the normal classes we spend a lot of time, but in this class we will spend. This is called, any points which fall here are called what? Are efficient. This is expected return, and this could be your standard deviation maybe. So basically risk is lower, return is lower. In this case, let's suppose I am using my words carefully. X is a portfolio here. So if X is a portfolio, there are three securities. Let's suppose ABC. There are three securities ABC. There could be, this is X portfolio, this is Y portfolio. Both are lying on the efficient frontier, minimum variance set we call it as. We want to create one more portfolio Z. We want to create one more portfolio Z which should lie here. There are some basic assumption. One basic assumption is weights are linear. The basic assumption would be weights are linear. Now when I use this assumption, sir, this chart would be of any use to us? Maybe no. But just get the feeling of it. If you hear these terms, minimum variance set is which is lying on the efficient frontier, and we assume weights are linear. Technically we'll use a corner portfolio theory or critical line, I can say simple words is linear equation. Now the question would give you, sir, portfolio X, this is portfolio X, it will have ABC, portfolio Y also ABC. Let's suppose he says he want to create another portfolio Z. Let's suppose I am creating a portfolio Z, yes. So let me create a portfolio Z in which I'll give you, in fact before I give you, you tell me, leave the C, leave C, how much is A moving by? 0.10, positive, negative, negative, minus 0.10. B is moving plus 0.10. If I tell you weight of Z is 0.5, so this is moving by how much? 0.3. Positive, negative, positive. So it was 10 point minus, it was plus, opposite 0.1:1. If the A is moving plus 0.3, what do you think B would move? Minus 0.3. Answer would come what? 0.2. That's the exam answer. Now what we'll try to find, does it come same? What will question say? Question will say, sir, what about C? C will be balancing figure. He says weight A. What, sir, once again come back please. I'll rub this part. If I give you this data, I have not explained anything to you. Let's suppose no critical line, no linear equation, no efficient frontier, no minimum variance. I say A is moving 0.3 to 0.2. How much? Minus 0.1. B is moving from 0.4 to 0.5. Relationship is equal, but in what direction? Opposite. Is that fine? So if he says I am creating new portfolio Z in which there would be ABC, which will lie on that same minimum variance set. If the weight is 0.5, then we'll say this is moving by what? Plus 0.3. This should move by what? Minus 0.3. Answer should come 0.2. And this will be balancing figure Z. Now sir, what should we do and try out is, let's try out our critical line equation. Only thing I'm changing here is I'm not using, these are linear, they're assuming a linear relationship, and what we do, the weights are linear. Equation was y is equal to what? Critical line, I'll put it here, y was equal to mx plus c. Now do not get confused please. M and x in the equation are securities. In our case, what are the securities? These are actually portfolios. So what I'll do, y I'll substitute as what? Weight of B. M, this I'll substitute by weight of A plus C, because X and Y are portfolio in our example. Is it fine? Now let's put down first point. 0.4 equation will be what, sir? 0.4 would be equal to M into, what is the weight of A? 0.3. First equation, X portfolio. This is portfolio X. Second would be what? 0.5 would be equal to what? M into 0.20 plus C. Solve it and tell me what comes out. It's 0.40, 0.4, 0.3, 0.5, 0.2 into M and C. When we solve, this gets cancelled. It is minus 0.1. This is plus 0.1 M. So for M comes something. M comes minus 1. And put it in equation. If this is my equation 1, if this is equation 2, put M in equation 1. Put M in equation 1. Put M in equation 1. So in this, if I put here, if 0.40 is equal to what? M into minus 1 plus C. Minus 1 into 0.3, sorry. Minus 1 into 0.3 implies, can you find C? What C comes out? Positive, negative? Positive 0.70. And then you can do what? Equation. So our equation will become as standard equation. Weight of B should be equal to weight of A minus 1 plus what? 0.70. weight of A plus 0.70. Now what did I say in the Z portfolio? What was the weight of A? In the Z portfolio, what was the weight of A? I told you, na. I was assuming in the Z, I gave you this. This we found as a balancing figure 0.2 by logical way. I said if in Z portfolio, weight of A is equal to 0.5. So can we find weight of B? Weight of B would be equal to 0.5 into -1 plus 0.70. How much do we get? 0.20. And I think actually we were getting the same answer. We were getting, look at this. This was our balancing figure, na? We found by normal looking at this. So this should be the answer. Point. And C would be equal to what? 0.5, 0.2, and that will be automatically 0.3. Is that fine? Now let me show you that question. In fact, I have just given that example only. It was the question data what I used here. Now let me read out this question. Investor has two portfolios to be on the minimum variance set for a population of 3 securities ABC having mentioned below. Weight A, weight B, weight C, exactly same data I use so that things become easier for you. It is supposed that there are no restriction on short sales. What would be the second part is actually what we did. First part I am reading, it's a general part. What would be the weight of each stock for a portfolio constructed by investing 5,000 in portfolio X and 3,000 in portfolio Y. So basically he says invest 5,000 here. If you invest 5,000 here, A will take how much, B will take how much, and C will take how much? 5,000 into 0.3, 5,000 into 0.4, 5,000 into 0.3. And if you invest 3,000 in Y portfolio, 3,000 in Y portfolio, it's 0.2, 0.5 and 0.3. How much do we get? So I think you get the same numbers, na? If I look at the answer, if it was 5,000, 5,000 would be equal to 1,500, 2,000, 1,500, and this was what? 3,000, 600, 1,500, 900. Total of A is equal to what? 2,100. Total of B 35. Total of C what? 2,400. Out of 8,000, when you calculate their weights, it will be 1, 2, and 3. Out of the 8,000, 2,100 is 0.26, 0.44 and 0.30. Now second part was what we were trying to do. Second is the answer what we've already done. Suppose an investor invests 4,000 out of 8,000 in security A. 4,000 out of 8,000 in security A. That's basically he is creating portfolio Z. And how much he is investing here? 4,000 out of 8,000. How much new weight? 0.50. 0.5. How he will allocate the balance between security B and C, ensure that his portfolio is on what set? Minimum variance set. That means they'll fall on that efficient frontier. Basically different weights, but they're all proportionately. Actually, what is it showing, sir? This efficient frontier, risk lower, return is lower, risk higher, return is higher. So it's basically accordingly managing it out. So what he wants is you have to create. Then what you'll do is, if logically we have done same example only, from here to here if I move, it will be what? Minus 0.1. This is what? 2. And we are assuming a linear relationship, and because of linear relationship this is coming, otherwise this answer cannot come. If this is 0.5, that is plus 0.3, this would be what? Minus 0.3.2. Exactly same thing you've got. Exactly same thing, same data I have taken. So we have done till here. The last part of the answer I'll show you, which you can add. So we calculated this part here. Then what we can do is, let me show you. Prima facie question is technical, but when you try to put out the data, so this is exactly what we have done. First part we have tallied from the book itself, basically 5000 into this. Second part was we created this equation, we put the equation. Now since 4000 out of this, if you want, I have given you actually a normal way that 0.5 I gave you, but 0.5 how did I decide was, since 4000, this equation you got same equation, no? WB is equal to minus, since 4000 out of total 8000 would be invested in what? A. That means weight of A would be equal to 0.5. New weight of B would be equal to, when we put in the equation we are getting 0.2, and weight of C would be difference of 1 minus 0.5 minus 0.2. In fact, in book I might have given the shortcut answer to you, since weight of C is constant 0.3, 0.3, 0.3. So simply you can do, some books might write that, but there could be a possibility C might have a different proportion. So you do exactly the same way what we have done. Do exactly the same way what we have done. So I have in the book, I think some of the authors might be giving the answer in that form, that since C is constant 30, 30, 30, A is 50, automatically B would be what? 20. But instead of that, you can apply, and this is not tough at all. In fact, pray that this question comes back again. This question comes because you are able to analyze the answer very easily in this part. So amount of investment would be A is 8000 into 0.5, B is 8000 into 0.2, and this is the final answer where you end. So you can copy the balance part, just write this word, because you should know how did I give you 0.8, 0.5. I gave you from my side 0.5. You should know how the 0.5 was given. Quickly copy that part, please. These are actually PhD level questions. It should not be a normal questions for the examination purpose. Done? Done? I think we have finished off the questions with the portfolio now. Yes. Let's start with a new topic, and I think let's start with new topic. IFM, International Financial Management. Let's move to the notes. You can download, those who have it's fine, else you can download from the drive. So IFM, let's start with. In this chapter we'll also take help of, or we'll get some part of the capital budgeting done. So this will be some part of the capital budgeting would be done here only. International finance, this will be, I'll just tell you briefly what exactly would happen here. We'll have a concept of the foreign exchange. We'll have some forex, some capital budgeting, and some other critical points will come into it. And one topic which I generally do in the class, I've been doing adjusted NPV that came in the exam, and I'll show you that what we have been doing and what came in the exam, so that you get hint out of it that something he has been asking, but it takes time over the period of a time. So I'll start with, first is basically the concept of the ADR and GDR. I'll not go into the depth of ADR GDR, assuming you would know. We'll just quickly cover up the question. Some new type of questions I'll try to spend time on, which has come in the exam the last few years. Some have been problematic, but there some have been which could be done easily and should repeat back again. So IFM I'm covering back. First question I'm covering. With the question only we are starting. This will give you hint with the of the forex. Odisha Limited has proposed to expand the operation for which it requires fund of 15 million net of issue expenses which amount to 2% of the issue size. So they want actually 15 million which is net of issue expenses. That means issue size would be equal to, grossing up if I do, 15 million is after the expenses. So before expenses that should be equal to what? How much? 98%. So it would be equal to 15.31 million. 15.31. The proposed funds, it proposed to raise the fund through GDR, Global Depository Receipts. It's considered the following factors in pricing the issue. The expected domestic market price of the share is 300. Actually, GDR is nothing but ADR and GDR. GDR is listed globally. If they are listed on the US, it's ADR. Basically, they club some shares, and based on that share, they issue the units. It could be termed as a ADR or GDR. It's a raising of money from the foreign markets. Basically, they are raising it money. So, expected domestic market price of the share is 300. 3 shares equal to 1 GDR. So, that means your number of shares would be 300 into 3. How much? 900. Underlying shares are priced at 10% discount to the market price. In GDR, that means issue price would be equal to 10% of discount will be 810. Exchange rate is $1.60. $1 is 60. It means if I issue in the US terms, the issue price would be 810 divided by 60. How much do we get? 13.5. So my issue price would be equal to 13.5. You are required to compute the number of GDRs to be issued. Number of GDRs to be issued. So when I say number of GDR, amount to be raised is what? $15.31 million divide by price is what? 13.5. How much do we get? 1.134 million. These are the number of GDRs. Cost to the DDR is nothing but K, cost of equity. And please remember the formula you will use is what you used to use in your inter-level. It's D1 divided by net proceeds. Since you have issue expenses or a flotation cost, instead of dividing by the price, the formula is D1 divided by P plus G. So you should use now the formula is D1 divided by net proceeds. So net proceed will be using cost. This is nothing but KE to Odisha Limited. If 20% dividend is expected to be paid with a growth rate of 20. So G, you know, this 20% cannot be a dividend yield. It's a dividend rate. Only thing is in this question they have missed out. Otherwise in the next question when next time it came, I think they mentioned face value is rupees 10. So you can assume face value rupees 10. That means D1 would be equal to what? 2. D1 expected to be paid. Expected is D1. So expected to paid D1 and your formula of KE is equal to, that is exactly GDR formula will become D1 by net proceeds. D1 by net proceeds plus G. So D1 is 2. Net proceeds would be 810 minus how much issue expenses? 2%. And G is your, G is equal to plus 0.20. G is equal to plus 0.20. So if I try to put out this number here, my cost will be equal to, in fact D1 do not put 2. D1 would be, since you are putting with respect to 3 shares, so D1 is with respect to 1 share, it will be 3 shares would be equal to 6. That will be 6 divided by 810 minus 2%. 793.8. 793.8 plus growth rate of 20. Sir, why did we use 6? Because 3 shares make 1 GDR. Second, we use 793.8 because there were issue expenses you would have done in your junior classes minus flotation cost. That's net proceeds. And third thing is we have used 6 as is, not added the growth because the dividend was given expected. So 6 divided by 793 plus 0.2. How much do we get? 20.76%. This is one of the common questions which comes in the exam. Let me just check out. This is on slide number 2. So I have the net amount 15 million. I'll quickly do a recap. You have the question in front of you. Issue expenses 2%. Issue size would be 15.3 million. Share price was 300. 1 GDR is equal to 3 shares. Price of 1 GDR without discount 900. Discount of 10%. Price of GDR after discount rate 810. 900 into 90. Exchange rate $1.60. Issue price in dollar is 13.5. Number of GDRs to be issued is equal to 1.134. That was the first part answer. That was first part. Cost of GDR D1 by net proceeds plus G. Assumed face value. Second time when came, I think they gave the face value. D1 is 20%. It is dividend rate. D1 for 1 GDR is rupees 6. Net proceeds would be equal to 810, 16.2, 793.8, and it comes 20.76. 20 point. This was the first question, which is the easiest part in the chapter we have. Now, second part I'll move to is this you can term as part of capital budgeting. You can term as a part of this chapter depending on circumstances. Questions have been regularly coming on this now, on this topic. Questions have been regularly coming on this topic. International capital budgeting. Now, when we use a capital budgeting, you know capital budgeting is NPV and normal discount rate. International means you will have to add what? Foreign exchange. That's it. So forex comes into picture. There are two types of approaches. One called home currency approach. Second is called foreign currency approach. The basic objective of this is rupee cash flow, discount rate rupee, dollar cash flow, discount rate dollar. That is the basic objective of this topic. Now, cash flow should be in rupee, discount rate should be in rupee, NPV will come in rupee. Now, it cannot happen that question will give you 4-year cash flow, discount rate and solve. This we do not even, this example we cover in the first class of capital budgeting in the inter-level. So the life cannot be simple. If it is look simple, make tough on your own. So you'll have to assume something different. When I'll show you the question, we'll come to know. The cash flows are in dollars. In this case, cash flows are in dollars. Discount rate would be in dollars. NPV would come in what? Dollars. And you can convert NPV dollars using what? Spot rate. That will convert. Now, what will happen in the question is either he'll give cash flows in one currency, discount rate in second. You have to convert either discount rate in the first currency or cash flow in the second currency, depending on what approach. If he uses a word, use foreign currency approach. If he uses a word, use home currency approach. You have no choice. If he does not use this, then it's your choice. Depending on data, you can convert. In case question is silent. Sir, question is always silent on approach. Silent means does not say anything. On the approach to be used, we can use any one of them depending on the data available. Foreign currency cash flows can be converted into home currency cash flows using forward rate or ESR. That means you have to apply which theory? IRP or ESR. The discount rate to be used should be risky rate. That's very important. Discount rate, because cash flows has a risk, discount rate should have risk. And remember this line, capital budgeting will become slightly easier for you. Risk-free cash flows, discount rate risk-free. Risky cash flows, discount rate should be risky. So risky, and not risk-free rate. And it's a multiplicative model. We call it as 1 plus risky rate of rupee. It's 1 plus risky rate of rupee. This I'll explain with you when I do the inflation concept, and I'll cover inflation in this topic only. So I'll tell you why it is a multiplicative. CAPM model is a addition when you add something, RF plus beta into something. Otherwise, generally we have a multiplication type of a concept. 1 plus risky rate of a rupee should be equal to 1 plus risk free of a rupee into 1 plus risk premium of a rupee. So the problem which comes in the question is, two countries will have different risk free. Yes. Two countries will have different risky rate. Yes. Actually, two countries should have a two risk premium also. You cannot have a riskiness of one country to be equal to the second country. But in question, if nothing is said, we'll assume risk premium of two countries is same. The risk premium of two currencies is different, but if only one risk premium, RP's risk premium, is available in the question, we will have to assume that both the currencies have same risk premium. Sir, what will we do? Actually, what will happen is, in the questions, what he'll give is, he'll give risk free of one country, he'll give risky rate of one country. For example, rupee. Using this, can you find risk premium of rupee? Yes. Then using that risk premium of rupee, he'll say, assume this is risk premium of, let's suppose, dollar, and then he'll give you risk free of dollar, and you calculate risky rate of what? Dollar. Understand what I'm saying? He'll give you risky rate of rupee, he'll give you risk free of rupee, you calculate risk premium of rupee. Then question data would be created in such a way that he'll say, assume risk premium of rupee same as risk premium of dollar, and once you know risk premium of dollar, and he'll give you risk free of a dollar. Using those two rates, you calculate risky rate of dollar, and risky rate is nothing but discount rate used, and then you have a cash flow in dollar, discount rate in dollar. First question, I think I might not have given in the book to you. I'll cover from my side, which is simple one. Then second part we'll cover is both the approaches, so that you're comfortable how to use them out. So let me look at some question. I think I might not have given it to you because assuming it was simpler. But since it will help us in covering capital budgeting also, yes, I have not given that simpler question. Let me cover from my book. This topic we are covering is IFM. IFM. Very good. So you might not have, I'll just show you the data. Yes. And we cover it. It's question number 9 I have. It's question number 9. You will not have, I'll just read out from here, and then we'll try to find out the answer, and then I'll give you one question to be done on your own. Can I do it? Yes. Let me try. It says ABC Limited is considering a project in US which will involve initial investment of what? 1 crore 10 lakh. The project will have how many year life? 5-year life. Current spot exchange rate is 48 per US dollar. The risk-free rate in US is 8%. Now this is dollar given, 5-year life, current spot rate is given, US 8% is risk free, India is 12. Cash inflows are as follows in dollars. Calculate the NPV of the project using what approach? Foreign currency. One country is India, so you know India is India, India is home country. That means cash flow should be in dollar. Are the cash flow in dollar? Yes. Required rate of return on this project is what? 14. Discount rate should be in what? Discount rate should be in what? Basically foreign currency means what? Dollar cash flow, dollar discount rate. Cash flows is in dollar given, and 14% they have not mentioned is in which currency? First of all, what do you mean by foreign currency approach? I have to solve in dollars or in rupees? Dollars. Cash flow should be in dollars, discount rate should be in rupees. Discount rate should be risk free or risky rate? Risky rate. So certainly I cannot use this 8%, certainly I cannot use this 12%. Can I use this 14? Depending on circumstances. Cash flow in dollar. Now my question is, this 14% is a dollar discount rate. It's a risky rate for sure. Is it a dollar discount rate or is it rupee discount rate? Now since you would have done this question, so automatically you would know this is rupee, and why is it so? My question is very specific. There are two views of looking. Since ABC was in India, some people say, sir, this is rupee 14%. Now what I say is, a 8 marks question or let's say 5 marks question, institute will not give you, beta, this is dollar cash flow, this is dollar discount rate. So write this discount rate, multiply these and get the answer. This you give to 11th class student, he'll do it. You have to increase your workload. In simple language, if I say, even if nothing is said, you have to increase your workload. That's it. Sir, if the cash flows were given in rupee, I would have asked you maybe this assume in what? Dollars then. Please understand what I'm saying. Because generally you think that if he says foreign currency approach, if you, this is already given cash flows dollar, discount rate has to be in dollar, and if you assume this as a dollar, then basically what is the work you're doing? If you would have done capital budgeting first class, when teacher is teaching you NPV, he tells you these are cash flows, this is discount rate, multiply and get the answer. Certainly that cannot be done. And once you know foreign currency approach, that means he's asking international capital budgeting. It means in exam sometime you have to look at the data and increase your workload also. That means you have to show your knowledge. He is not asking, but show your knowledge. I know this is in what rupee, so I'll use this risky rate, I'll use this risk free, I'll calculate risk premium of rupee. Using that risk premium of rupee and dollar, I'll calculate what? Risky rate of dollar. Actually, I expect institute should give you clarity, because practical life, these are not the problems you face. When you're solving a question or when you're doing some project work, you do not, your boss will not tell you, oh, you on your own assume which rate is this and then solve. You know, I have raised my money, and when I'm raising my money, this costing is in the dollar or this costing is on the rupee. So he should mention. If he does not mention, they have a habit, and we assume that this is a risky rate of a rupee and these are the cash flow of dollar. I do not have to convert cash flows into rupee, rather I have to convert rupee discount rate into dollar discount rate. So when I go, if I look at first part of the answer, what I do is calculation of risky rate of a rupee. So risky rate of a risk premium of a rupee, sorry, risky rate of a rupee, risk free of a rupee, which will give me what? Risk premium of rupee. And using that risk premium of rupee 1.79, it will be assumed, they do not write but you write in the exam, assumed risk premium of rupee is equal to risk premium of dollar, and that will give you what? 1.79. Then you can calculate what? Risky rate of rupee, and this will become your discount rate. This will become your discount rate. Now I have given the logic, I'll show you the question. Take 5 minutes, try on your own. This question has come, I think, in the last 3-4 years 3 times in the exam, because there are specific questions which come. One is this, one is second question. I'll show you. So try once this quickly. You have this data points with you. So I have given you the hint, and my answer will come in, I think I have taken 2 decimal risky rate. Yes, 2 decimals. Whatever answer comes, it's okay. If you want to make a mistake, you make a mistake. This was original question which came long back. Latest questions also I'll show you. I have taken some questions. Quickly try it out, please. Take 5 minutes time. Try out. First find what, sir? Risk premium of rupee, then risky rate of dollar, and then discount it back. Try out. My answer is coming as risky rate of dollar is 9.93, and then when I discount back, the cash flows are dollar 2 lakh 9.93, 18 lakh 20,000, 67,500, and so on. So my PV of a cash inflow comes out. PV of cash inflow comes out as 120, 10500. Outflow is 1,10,000. NPV, NPV in dollars, convert at spot rate in rupee term. Cross check your numbers, please. We can assume required return of dollars. That's what I was saying. He says we can assume this required return is of a dollar. That is what I said. Just wait. He's saying we can assume discounted dollar. When we start capital budgeting in inter, how do we start? I start what is CFAT, inter. Then we methods of depreciation. Then I teach them capital budgeting techniques because they are learning for the first time. It's called NPV, PI, etc., IRR, modified IRR, payback, we are accounting rate of return. If you would have done the full time, then I would have done this in the 10, 12 or 15 or half an hour, 1 hour time. What we do in a one class. Then each technique I take one example and keep teaching them. Then comes discounting techniques. Which technique? Discounting. First is NPV. Then I teach them NPV is first year inflow, second year, third year, discount back to 0 period. And interestingly, then I take this example, any one example, 2 lakh, 2 lakh, 2 lakh, and discount rate. What you are saying is the cash flows were in dollars. If I assume discount rate in dollar, then there is no difference between the introduction class of capital budgeting at CA Inter. If it was in foundation, I would teach same example in foundation. If it was in the 11th class, I would have done same example in the 11th. Now, if I assume your choice, that is exactly what I am saying. That is exactly what I was telling to you, that if you assume this is in dollar and this is in dollar, then where is the knowledge of CA final? CA final knowledge you have to show them, they do not know. So you have to use your CA final knowledge. That means you have to assume this is in what? Rupee. And exactly same thing I am saying. If by chance this was given in rupee, then I would have assumed this in dollar. Whether you like or do not like, I have to show I know something more than you. So exactly same thing has to be done. You understand it cannot happen that he'll give you dollar and just simply and multiply and calculate the answer. No, it cannot happen. Some part has to be done. Either he would have increased your workload somewhere else, maybe in the inflation part, maybe in the currency calculations part, which I'll show you subsequent questions. Then it's okay, I can assume the discount rate could be easier, or let him mention. If he does not mention, that means you have to utilize some knowledge of the CA final. You cannot simply multiply two numbers and get the answer. His question was same what I said to you, that why can't we assume that discount rate is in dollar? That is the same thing he was asking. Is it fine? Come back. Can we come back now? Let's come back. The question which I gave you, in fact, I gave you by both the approaches. I want you to read this question once and mark it as important. It came recently. This will involve your currency calculation also. Question number 8. Read it once, please. Question number 8. Now let me read out. In fact, if you want, it says DK Limited is considering investment proposal in Sri Lanka involving initial investment of the Sri Lankan currency 25 billion LKR. Current spot rate is, oh my god, 1 LKR is equal to rupee point. If you are not able to identify, you assume which approach? Academic style. What was academic style? Rupee per dollar, rupee per LKR. The problem in the exam comes in these odd currencies. Confusing comes. He could have given in dollar, it was easier. It's how do you write? 1 LKR is equal to 0.37. Academic style. Risk-free rate in India is 6. Same in Sri Lanka is 5.02. Project will generate cash flow of LKR 5 billion in the first year. The cash flows will increase by 1 billion each year for the next 4 years. That means it will become 5, 6, 7, 8 and something. Project will not bind up, it's wind up. In the completion of 5 years with no salvage value, the required rate of return of the project is 8%. Now understand the meaning of it. I'll take your help only. Cash flows are in which currency? LKR. If I assume discount rate is in LKR, no, I cannot. In fact, I'm saying question also gives a hint, but anyhow, you can imagine it's India going somewhere. So this is given in which currency now? Rupee. You did not have a choice because you have to show your knowledge. You're required to find out investment worth projects by home currency approach, foreign currency. Now understand what will happen. Look up please. Look up. If I use foreign currency, that means cash flows will be in which currency? LKR. Discount rate will be in LKR. Cash flows are given in what? LKR. Discount rate is, we cannot assume in LKR, we'll assume in what? Rupee. That means you'll use what formula now again? If 1 plus risky rate of rupee is equal to 1 plus risk free of rupee, it will give you what? Of rupee. You can calculate this. Then using this and risk free of what? Sri Lanka. Can you calculate risky rate of the Sri Lanka? Just calculate for me and tell me what comes out, because answer is not given to you. We'll have to calculate. Now let me give you one hint. Look up. If you work smartly in the exam now, look up. In home currency, you'll do what? Cash flow should be in what? Rupee. Discount rate. Is discount rate given in rupee? How much percentage? 8%. So cash flows you have to convert. We'll speak about this. Present value interest factor, present value factor 8%. Second factor is given what? 7. It means this answer should come around. I am assuming next time examiner can become smart, he can give you 3-4 rates. You're getting my hint, what I'm saying. So examiner maybe was not in the proper mindset. He was maybe half-heartedly making question, gave 2 rates. He thought one is 8 and one will come 7 and he gave 7. But you have to solve, it should come 7. Try 2 times at least if it is not coming 7. But now don't keep trying 7 is not coming. If it comes, then do it. That means basically you are getting a hint. Second rate is 7%. How much you get? 7 only. I hope you are getting my point. Sometimes smartly also work with the alertness. You'll come to know that second rate will come 7%. In first case, sir, what we'll do, since we have to convert our cash flows into what? Rupees, and they are forward cash flows, risk-free rate is given. We'll apply what? IRP. So help me out once, then I'll show you my answer, and then you can cross-check your answer. What was your, just for the knowledge purpose, what was your risk premium of the rupee coming? Anyone who has done? 1 plus something. No, 1.0189. This is entire, this term you're telling me. 1.0189. And then when you apply this you're getting 7. If it is coming rounding off also, make what? 7%. Now let's work on how do we convert our cash flows. How do we convert cash flows? This help me out with the IRP theory. IRP. IRP was, sir, what? If you forget the theory, how to remember? Look up, please. The best way to remember is same way I create the theories. If spot rate $1 is 60, interest rate of the dollar is 2%, interest rate of India is 10%. So India will become 60 into 1.1. Dollar will become what? 1.02. So $1 would be equal to this divided by 0.2. So formula basically becomes is my forward rate is equal to 60 is my spot rate, 1 plus what? Right hand side currency interest rate. You do not, in case you are not able to remember the formula, remember at least the basic part of it. $1 2% rate, 60 rupees 10% rate, 60 will become 66, 1.02, 66 divided by 1.202. So logically you can create your formulas. Divide by 1 plus what? Left hand side currency interest rate. Now what is my spot rate available? Tell me the spot rate. 1 LKR is equal to rupee what? 0.37. So let's first year. This is helping us in recap of forex also. First year would be, I have to calculate the forward rate would be equal to, spot rate is 0.73, risk free was 1.06, 1.05, it's 2 or 0.2? 0.2. Calculate the 1 LKR will be equal to what? 0.3734 or 0.373 or 0.3734. He should mention the decimal. This is a problematic things. I don't know how the solutions of this will arrive. So it's 3 I am putting in. You can put 4. He has to mention. Second year, what we'll do is, now don't keep doing again and again. Just simply do 1 LKR would be equal to 0.373 into what? 1.06 divided by what? 0.2. 0.376. So quickly calculate all the 5 rates. Third year I'll calculate 0.38, 0. Fourth year 0.38, 4 or 383. Just see the fourth decimal and do it. And fifth would be 0.384 into 1.06 divided by 1.50502. 0.388. Is that fine? Now another area of a mistake. You have the book now with you. You tell me the cash flows. Cash flows are given in what? LKR. First is what? 5. Second is 6, 7, 8 and 9. You have to convert to what? Rupee. In between I'll use exchange rate and then I have to convert rupee. Now be careful please. Convert anyone. This first one. What rate you'll use? 0.373. How would you use 0.373? Multiply or divide? Multiply. Now let me put down. This cash flow is in what? LKR. That means LKR should be on what side? Left side. Left to right I'll go multiply, and by chance it is given 1 LKR is equal to 0.373. Sorry, 373. So we'll do what? Multiply. You'll get some number here. 1.867, whatever number comes. And then once you get this, then discount rate of India is what? 8%. Is it fine? I'll show the answer. Generally I discuss this in the class and then I give them as a homework, because there are multiple questions of this IFM. Yes. This was question number 8, no? I have sheet. Hmm. Look at this question number 8. So I have question number 8. You are getting 0.7373, 376, 380, 384, 388. This was the rates you were getting, and then the first part you multiply 1.865, 2.256, etc. Discounting factor he has given 5 decimals. Question. Hmm? Achha. If he gives 5, assume 5 only, please. So 5 decimals and then NPV comes. Then NPV comes. I'll remove myself. If you want to take a photo, you can take, so that you can cross tally at home. The first part also. This is the first part. Second part also I'll show you. This is the first part answer. Second part answer was this foreign currency approach. I think 7%. Second part we were getting, I think, 7%. This was basic requirement. Rates he has given. Cash flows will be exactly same. He said increasing by this 25 million he gave you. I think the answer. By this he has tested your the capital budgeting technique also. He has tested your forex also, and it's a combination of capital budgeting forex. Both has been tested. We'll test you both the approaches. This question becomes slightly lengthier because he's asking in the both the approaches. Can we move forward? Now let me move. Let's move to the inflation, which is again a capital budgeting topic. Since we have a question which comes in this, so I'll finish off here only. It's a part of the capital budgeting. When you go back in your study materials, you can find capital budgeting also, inflation. So inflation, I'll talk to you. Important topic, inflation. In fact, a very important topic it has become over the period of a time. A very, very important topic it has become. Inflation. It says inflation topic whenever will come will tell you real or nominal, two terms will come. They'll tell you whether you have to assume the real term, nominal term. Real is basically the term which does not include the impact of inflation. The nominal will include the impact of inflation. The cash flows are known as real cash flows, means they do not include any kind of the inflation points here. The cash flows are known as nominal cash flows or a money cash flows. Now Actually look at the way of doing it. Nominal means it includes the impact of inflation. That means nominal cash flow is real cash flow into 1 plus inflation. We call that as a compounding effect. The cash flows when we have, look at here, a real cash flow is a discounting. It means from when we do divide by, it's called discounting. The future value divided by 1 plus r. So it's a discounting effect. That means nominal cash flow is real plus into 1 plus something, compounding. The real would be nominal divided by it. It's called discounting. The discount rate to be used should be real discount rate. The apple to apple comparison we call it as, or oranges to oranges. Real cash flow should be discounted by real discount rate. The nominal cash flow should be discounted by nominal discount rate. Again same will come. Question will come. 3 cash flows, discount rate, solve. You will have to assume if cash flows are nominal, discount rate is what? Real. Unless and until some other burden has been done. There are some few questions which come 3-year cash flows and discount rate. Then please do not assume in that smaller data in capital budgeting you will find that there could be possibility 3-year cash flows, 3-year the discount rate is given, and if prima facie mentions fine enough. If it does not mention, then you assume what? Opposite side, so that you show your working. So objective is cash flow should be real, discount rate should be what? Real. If the cash flows are nominal money terms, discount rate should be nominal money terms. Now in this case what we have, how do we use this? I have used the formula here, 1 plus nominal discount rate, again multiplicative. I'll explain with the help of an example here, is 1 plus real into 1 plus inflation. Now what is a real? I have spoken this term with you in the capital budgeting also. Real is actual, which is because of the efficiency of the asset. Now the two formulas which are required for me exam purposes, one is this formula, these formulas, either you have a compounding discounting effect, second is the rate. Now I have taken an example. Machine value is 1000 today, cost of machine will increase by 10% due to increase in efficiency. My wordings are very clear, and mark this topic as important from this also, from capital budgeting point of view also. So both sides this topic will become important for us. Now when we say increase in efficiency, the increase in efficiency is called real return. Increase in efficiency is called real return. Now when machine capacity increases, machine does not know I am in India, I am in France, I am in Japan, or I am in Pakistan or Afghanistan. Machine is a machine. So the increase in efficiency and increase in pricing due to increase in efficiency is called real return. Understand what I am saying? Any kind of Activa where you drive, the Activa does not know which roads I am there. You drive in the Hyderabad or Hyderabad of Pakistan or wherever you want to, it will be Activa. If 100cc bike becomes 125cc, we call that as a real return. Real means increase in efficiency comes in. The impact of inflation is 5%. Why multiplicative model comes, or why we multiply, I am trying to explain you that only. That why we plus 1 plus and 1 plus so on. We do not simply add that real return is 10, inflation 5. We do not simply add. This example will help you out in that. Calculate the value of machine after 1 year and percentage increase in the value of the machine. Now existing machine value is what? I have 1000 lakh. 1000 lakh. Increase in value due to efficiency increase. How much we are increasing it by? 10%. 100 lakh plus 10% is 100 lakh. 1000 lakh plus 10%, 100 lakh. So it becomes 1100. And then add the impact of inflation. That means you are adding the impact of inflation in the original machine plus in real terms which has increased. Understand the formula also. That means you are adding the impact on this inflation of 5% is added in this 1 rupee also, which is real, and in this 10%, which is the 1 rupee principal plus that real. That is the reason which comes out. And if you look at the increase, the value of the machine becomes 1155. 1000 lakh plus 100 plus 55, percentage increase is not 15%, it is 15.5. And why 15.5 comes in? Because that impact of 1 rupee has come and then impact of 10% has come, and that is why this formula also gives you same thing, 1.1 into 1.05. 1.1 into 1.05. So we call it as, it's a multiplicative effect which comes out. Now sir, why have we used these rates by the way? Because in question you have to be specific about, is the cash flow real, is the discount rate real. If real we have, you can solve accordingly. If nominal you have, you can solve accordingly. So this is because of that reason you have to look at the data point. I'll do one small example to understand the flow, because that's actually a question of the capital budgeting only, which used to come in the capital budgeting earlier. Now since they have reintroduced, I think those kind of questions will not come because they have ample scope now to ask. Moving to the next slide, I have taken a small example here. This was exam question actually. Using the following data, calculate the NPV of the project, cash flows including inflation. The wordings are cash flows including inflation, nominal terms. 30 lakh, 40 lakh and 30 lakh. Outflow today 70. Cost of capital in real terms is 10. Inflation is 5%. Actually, even if I would not have said the cost of capital in real term is 10, still we would have meant it's in 10 only because inflation is 5. Again, you cannot simply assume nominal and solve this smaller question unless until some other data points are there. So what we do is two ways of solving. These are what cash flows? Nominal. I can convert this rate using formula the 1 plus nominal discount rate. 1 plus nominal discount rate should be equal to what? 1 plus real discount rate into 1 plus inflation. So we get 15.5. It means solve 30 lakh, 40 lakh, 30 lakh using 15.5. If I solve this, I get answer as, sir, these factors are 1 divided by 1.155, 0.866, 0.750, 0.649, 0.866, 0.750, 0.649, and you get 75.45 minus 70. You can cross check. I think numbers are right. Numbers are right. Is it fine? That comes 5.45. Now, sir, if I have to solve using real, then real cash flow versus real discount rate. We have discount rate already in what terms? Real. Nominal cash flow includes the impact of what? Inflation. If I have to remove the impact of inflation, discounting or compounding? Discounting. So look at this please. Nominal cash flow, when I discount by 5%, what was the inflation factor? Inflation 5. If I discount by 5%, I get what? Real. So these are my real cash flows. Sir, but the formula you showed was nominal divided by 1 plus inflation. Now like you can do this way also. 30 divided by 1.05 to the power 1. Then next year is what? 40 divided by 1.05 to the power 2. And third you can do 30 divided by 1.05 to the power 3. I use that factors. Some people cram it. Students have a habit. Oh, acha. When we convert nominal to real, then 2 time discounting will come. Now I don't know how do you remember. Simplest way to remember is nominal, remove the impact inflation. That means discount at the rate of inflation, get the real, and then discount real. Now, if you want to understand the mathematics of it, if you have regard and love for the mathematics, then when you multiply this 0.952 into 0.909, you'll get same as 0.866. 0.952 into 0.909 will be same as 0.866. That means single time discounting by 15.5 or 2 times discounting 1 by 15 and then by 10. It gives you the same kind of result. Sir, but your answer is not coming same. I have made it same, whether it comes same or does not come same. It has to come same, whether you discount by 1 time nominal with the nominal discount rate, or you discount nominal discount at the rate of inflation, get real, and then real discount at the rate of what? Real. You get what? This rate. 0.9098266.751. This is exactly what you get. It's fine. You want to cross check, then I'll move to the some lengthier questions. And depending upon your the working, we'll see that some at least 2 questions I'll cover. If requirement, we'll cover 1 more on that. At least 2 I'll cover which are lengthy in the nature. Just look at the data please once quickly. Done. Now first variety of a question which came long back, after that there was slowness, then RTPs had something, then questions started coming in. The question which comes on this topic is, let me go back, we have, this is not the question, question number 3. What we are covering, actually I have tried my level best to cover such question which will give you ample practice of it, then you go back home and try rest of them. This will help you in getting a flow of the topic. In fact, one test I think I have given to you earlier chapters. If you say after that whatever topics are there, one more, and then we can have one for the throughout the syllabus. Depending on if you say, I'll create accordingly. The objective test is not the test, objective is you revise your notes. That's it. Because since you're spending time and in the assume that there could be very high probability you'll get more time for the exams. So if you get that time, so there's high chance another 4-5 days finish off the AFM completely from your side. Means I might take 2 more days or so, 2-3 days, whatever time I'll take. Then you finish off entirely. That means so that after 5-7 days once pick up, try solving question, after 5-7 days pick up and try question. So maybe in the next 3-4 days try that, entirely focus on this topic only, so that at least you're comfortable that we have reached first level. Then another 10 days time, in 10 days time give 1 hour 2 hour times to this, so you do a recap of the subject. The question number 3, I'm doing it with you. XY Limited is engaged in large retail business in India. It is thinking for expansion into an African by acquiring a group of stores having the same line of operation that of India. The exchange rate for the currency of the proposed African country is extremely volatile. The rate of inflation is presently 40% a year. That's Africa he is talking about. Inflation in India is currently a 10%. Management of XY expects these rates likely to continue for foreseeable future. That means inflation will keep growing at 40% in the Africa and 10% in the India. Estimated projected cash flows in real terms. Now the moment it comes, start assuming, he'll talk to you about real and nominal. You have to you have to change your gears in the exam. Same question he could have given capital budgeting, same thing he can give in some other topic. The moment he use real, that means your mind should shift. Real cash flow, real discount rate, nominal cash flow, nominal discount rate. Now how the question will adjust, that you have to see. Real terms in India as well as African country for the first 3-year projects are as follows. Year 0, year 1, year 2, year 3. Cash flows are rupees 1000 African rands. 50,000 minus and 2 lakh, that means they are doing investments. This is done in the Indian rupees, this is done in the African currency. India business is showing loss and African is showing the profit. XY Limited assumes the year 3, look at the word now. XY Limited assumes the year 3 nominal cash flow will continue to be earned each year indefinitely. Perpetuity concept. It's not talking real, he's talking nominal. So cash flows on the top are real. After that he gives a nominal and he says these cash flows will be earned till perpetuity. It evaluates all investment using nominal cash flows, nominal discount rate. So he has made your life simpler. It means discount rate you will use is nominal, cash flows you will use is nominal. The problem you can imagine, or the work you have come to know, is I have been given what rate? Real. I have to convert into nominal. The real to nominal would be adding the impact of inflation. 0 period, real, nominal, both are same. 0 period, real, nominal, both are same. Now what we do is, if 1 year we have data, add 1 year inflation. If 2 year inflation, that means the India, if I talk, first year cash flow 10% inflation, second year cash flow another 10, 1.1 into 1.1, third year would be 1.1 into 1.1 into 1.1, and these I'll add what? 40 percentage. This will become the nominal. The problem is both of them are in different currencies. Now if I have to calculate a single capital budgeting technique, I have to convert either the rupee into the African currency or African to rupee. Now let's read further and come to know what he says. And one thing is for sure, third year cash flow will come in nominal once we have added inflation, and that will become this part here, perpetual. Then we'll see what to do. He says the present exchange rate is African rand 6 to rupee 1. That means 1 rupee is equal to African 6. You are required to calculate the NPV of the proposed investment considering the following: African cash flows converted into Indian rupees and discounted at risk adjusted rate. So life has been made ultra simple. What has to be done? Our workload is what? Add the inflation of India in Indian currency, get the nominal Indian rupees. Add the inflation of Africa in African and get the amount in African currency. Then using the inflation rates, calculate the estimated or ESR using purchasing power parity, and then convert the African cash flows into what? Rupee cash flows. Add African converted rupee cash flows with the rupee cash flows, get total cash flows, and then that will be 1 year, 2 year, 3 year. Then apply a no growth perpetuity, a terminal value formula. The terminal value will give you a perpetual formula, and then you can discount back. He says he has given very clearly first part, all these cash flows will be discounted at rate of 20%. Now there is no doubt here, all cash flows will be discounted at 20. This 20 is now what? Nominal. Sir, how do you know? Because he has already given nominal will be discounted by nominal. That means when he says discount by this rate only, this is a nominal rate. There is no challenge here now. The rate is not disputed at all. And why it is 20, he tells you the reason: ignore taxation and the rates factor are given to you, and then it is given. So my task, basically two tasks I have to do is, one is he is asking me a forex now of the inflation concept to calculate the ESR, the rates. And remember, 1 rupee is equal to African rand 6. That means you'll have, if you simply do it, if you recall back the formula just now we did. So ESR, when I calculate, I'll be doing is right hand side is 1 rupee is equal to African. So the moment you write this spot rate, 1 rupee is equal to African rand, how much? 6. Right hand side is Africa now. 6 into 1.40 divided by what? 1.10. This will be first year. Then into 1.40, 1.10. Then into 1.40, 1.10. 3 rates will calculate. So first year I'll calculate, second year I'll calculate, third year I'll calculate. This will give me first year. What rate do I get? 7.64. Second would be, sir, right hand side 7.64 into 1.40 divided by 1.10. 9.72. And then I'll calculate 9.72 into what? 1.4 divided by 12.37. 12.37. Now what I'll do is, cash flows are given. The cash flows I'll add their respective inflation numbers. So I'll show you the answer. I expect you to just quickly cross check the numbers from the sheet, please. Look at the solution. This was question number 3, na? So it's ICB with the inflation we have. So spot rate was available. 1 African is equal to, those who have the slide is okay. Otherwise, when you go back home, below the link, you will have the link of the drive also. Anyone has checked it out? I think, because I'm not very habitual of this. So it is coming right, I think. So you can download from there. Because that link I might be using for some case studies also going forward. So what I'll do is, since that link is there, na, so any kind of a case studies or MCQs, I'll keep uploading there only, in case I get something from there. So calculation of ESR and using PPP, ESR by SR, the first year ESR we get is 7.64, ESR of second year is 9.72, ESR of third year is 12.37. This exactly you told me. Now what we can do is, sir, calculation of nominal cash flows. Nominal cash flows would be equal to rupee. Real cash flows are given 0, 50, 1, 2, 3. It is not necessary this format you follow. You can follow any of the format. Objective is to get the real into nominal, and then African nominal into the rate. That be careful, because left to right when you move, you have to be careful. It is given rupee is equal to Africa, whereas you will be moving which currency to which? Africa into rupee. So be careful when you move. Do not be in a hurry. Left to right, left confirmed currency, right rupee, and then you multiply. So I multiply, I have done inflation factors 1, 1.1, 1.21, 1.331. So what does it mean? A 1 rupee today will become 1.1, a 1.1 after 1 year will become 1.21, a 1.21 after the another year will become what? 1.331. It will become 1.331. So we'll have 50,000, 1650, 2420 and 3328. And then we have the African cash flows 2 lakh, 50, 70 and 90. Inflation factor, a 1 rupee today will become 1.4 into 1.4, 1.96 into 1.4, 2.744. Then these cash flows, be careful please, African into rupee. So I've converted back. You had, this was 1 rupee is equal to African currency 7.64. 1 African currency would be equal to what? Rupee 1 divided by 7.64. So left to right, when you go, you'll do what? Multiply. That's basically divide, which is coming here. So I have 1 by 6, 1 by 7.64, 1 by 9.72, this, and I'll get nominal cash flow in the African currency, and total nominal cash flow we'll get as these rates. Is fine. So we'll get this. Now he said last year cash flow would be a perpetual. Since he did not mention the growth, no growth perpetuity formula, no growth perpetuity formula will apply this concept terminal value. No growth perpetuity formula. So my last year nominal cash flow would be basically what we do is when we do, for example, when we calculate P4, we calculate D5 divided by KE minus G. If there is no growth, it will be D4. When there is no growth, the perpetuity formula is D divided by KE. Similarly, we have last year divided by the discount rate. We get this number, and then 1 year, 2 year, 3 year, third year, and then this gives me the NP. Quickly calculate. Look at the numbers, please. Look at the numbers quickly. Just check the numbers once quickly, please. Then one question I'll give it to you. Try on your own. If you have done this, then look at question number 19. Look at question number 19. Read out quickly, then I'll discuss with you. Let me read out with you. In fact, I'll give you 5 minutes to try on your own, roughly, means in a fast forward manner, the flow, and if you can calculate the numbers. No formats required. MNO, a company based in India, manufactures very high quality modern furniture and sells them to small number of retail outlets in India and Nepal. It is facing tough competition. Recent studies on the marketability of the product have clearly indicated that customers are now more interested in variety and choice rather than exclusivity and exceptional quality. Now I don't know why they keep giving language. Give the numbers. We have to solve only nalaik. 1, 2, 3, 4 line. Since the cost of quality wood in India is very high, the company is reviewing the proposal for import of woods in bulk from the Nepali supplier. Now, from the first 5 lines, I only come to know there is Nepal and India. That's it. Number wise, there is nothing. In case there was a case study, then feelings would have come. There is no feeling otherwise. The first 5, because the moment they remove the first 5 lines, question cannot be framed. The estimate net India rupee and Nepali currency cash flows in nominal terms. That means they are including what? Inflation. For this proposal is shown below. Net cash flow Nepali currency and Indian rupees. The following information is relevant to you. MNO evaluates all investments using a discount rate what? 11%. Now you do not have to challenge. It means cash flows are nominal and this discount rate is also what? Nominal. That's it. Means there is no scope left now. He is saying discount by 11%, you discount by 11%. All Nepali customers are invoiced in Nepali currency. Nepali currency cash flows converted into rupee at a forward rate and discounted at the Indian rate. That's fine. That means basically everything is saying these cash flows we have to convert in what? Rupee, and that rupee also he is giving a hint has to be calculated using what? Forward rate, and for that he would have given some data and then discounted what rate? 11%. Inflation rate in Nepal and India to be 11 and 10% respectively. Current rate is what? 1 is 1.65. You are required to calculate the NPV of the project. So first task would be, if I put my data points here, let me put, since these are given now, so what I'll do is I'll directly write here exchange rates. Before that, let me calculate the exchange rates roughly. The rate is given 1 rupee is equal to Nepali currency 1.65. So Nepal is in the right hand side now. You become the expert by now. So first year answer would come as 1.65 into Nepal rate, that is 1 point. Nepal is what? 1.1 divide by Nepal is 11 na, so 1.11 1.11 divide by 0. Tell me the rate. 1.665. Similarly, simply calculate 2, 3, 4 and 5. Simply calculate second, third, fourth and fifth. How much do we get? One point 1.68. Next one 1.695. 1.771. Next one 1.726. Now you're converting Nepali rupee into what? Indian rupee. That means left hand side will keep what? Nepali currency na. So basically, can I say I'll write here 1 Nepali currency is equal to rupee. That means spot rate is 1 divided by 1.65. First year would be 1 divided by 1.665. 1 divided by 1.68. 1 divided by 1.695. 1 divided by 1 point, left to right we multiply. So we are converting Nepali currency into rupee. 1 divided by 1.726. So 38 divided by 1.65, you will get some number. 38 divided by 1.65 will get some number. 2 decimals you can calculate. It's a million 20. Or 3 also you can do 23 point. First one 30 minus 23.03. Second one 1.8 left to right. I hope you remember the forex rule. Left side confirmed currency, left to right will do what? Multiply. So 1.8 divided by 1.665. 1.081. Next one 1.905. Next one 2.419. 3.158. 3.766. 3.766. Now what you can do is, this is in rupee now. This is in rupee now. So what you can do is, you can add rupee, 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 rupee. These you can add. So this will become total cash flow in the rupee term. Total cash flow in the rupee term. And then you can discount the factors he has given. What rate? 11%. Then we'll find present value factors. Although I generally write forward of PV cash inflow minus outflow, so outflow is given on the top, so we can use 1 year factor, and then this will be there, and then we can have PVCF, and this will be our NPV. Total cash flows will be, first one is same, I think 23.03. Next one 1.9 plus 1.081, 2.981. Then 5.405, 6.819, 8.958, 10.667, 667. Present value factors 11%. Present value factors are 3 decimals, 0.901. Next one 0.812, 0.731, 659. Last one 59 total. 1 point. Total, tell me what comes. After minus 23.03. 1.258. NPV is positive. Done. Now if you want, I can cover one more part which has similar to it and a concept of modified IRR, fast forward manner if you want. Modified IRR is a concept of a capital busting. Anyhow, you'll require maybe since capital busting has come, we never know he can ask you that question. I think I might not have given it. Yes. If you want, we can cover it. Let me see once if I can fast forward manner cover it with you. You know what is modified IRR, by the way? No. Let me do a recap. Modified IRR, let me go back to the interlevel. Why it comes, why it happens, there was some problem with the IRR and so on. I'm not discussing anything straightforward. I'm going to the modified IRR. IRR, when it is modified to some extent, we call modified IRR. That's it. So some process is changed in that. Basically, what we do is, let me take the help of the data only. Modified IRR. Outflow today 2200. Inflows are as follows. Cash flow year 1, 2, 3. These are the cash flows. Discount rate is 10. Actually, he should have given a reinvestment rate. If nothing is said about the reinvestment rate, we assume it will be reinvested at the rate of the KO. IRR had some problem and there used to be dispute between the IRR and NPV, and because of that, then we used to move to the modified IRR. First step is calculate terminal value. So what is the objective of terminal value? Objective of terminal value is that if you earn this cash flow, this cash flow, this cash flow. Cash flow earning assumption is at the end of the year we earn cash flows. So if we earn at the end of the year, that means 770 if I earn, and if I invest that for 2 years, because my project life is 3 years, then 1 year and 2 year interest, my balance will become 931.7. If 968 I earn, which I earn at the end of what? Second year, because the assumption of the cash flows is at the end. So my value becomes 1064.80. Third I earn is 1331, which will remain 1331. We call this as a terminal value. Simple meaning of this is 770, 968, 1331, which I earned over the 3 years. If I reinvest them, what would be my balance at the end of the 3 years? My balance would be 3327.50. Now, to calculate modified IRR, let me put in a very simple wordings. It is actually a compound amount formula. Compound amount means that means if I try to look at this data, if I summarize now this data, I say the outflow, how much I assumed was 2200. We say if 2200 I invested today and the balance becomes 3327, what is my earning rate? But if I put principal and compound amount, you might not get the marks. But simple wordings is, this is the terminal value, this is what? A present value. You have to find such rate so that they becomes equal. That becomes a modified IRR. So it's basically compound amount is P into 1 plus R to the power N, third year discounting. I have to find that R. And then when I say at modified IRR, PV of terminal value, that means 3327. So once again, first was reinvestment of the cash flows, calculate the terminal value. Second is calculating the discount rate now. Present value of this terminal value should be equal to the outflow today. This is terminal values at the end of 3 years. We say it's at modified IRR, PV of terminal value should be equal to outflow. So terminal value divided by 1 plus R to the power 3 should be equal to what? The outflow. And when I solve this process out, I get my R as 14.27. So how do we solve 1 to the power 3? Under root 12 times minus 1, and you use some formula that you would know. When you calculate that, you will get 14.79. It means basically I have applied this formula only. If you look at compound amount divided by 1 plus R, but you cannot put this way. The two processes, calculate terminal value divided by 1 plus R. Terminal value is nothing but compound amount should be equal to the present value. It's 14.79. Now how this would be used along with, sir, the question. Let me go back to the question now. How we will be using along with the question. I'll just show you the question. You might not have in your notes, so you will have to refer mine only. This is modified IRR, na? Yes, modified IRR. Modified IRR. Yes. Same Nepali currency question. Same Nepali currency question. You will not have in the notes, please. So you have to refer mine only, question number 5. I thought since we have covered the Nepali currency, I did not take it in the notes. Exactly same lines, just a modified IR. I'll quickly go through it. When you go back home, you can relook at this video again if you want more clarity. This was in one of the RTPs, I think. And since you have a capital budgeting now, it's a very high chance they can repeat this question. XYZ company based in India manufacture very high quality modern furniture, sells to number of retail outlets in India and Nepal. Exactly on the similar lines. I think that was also India and Nepal only. It is facing tough line is also like same. Recent studies on marketable products have clearly indicated that customer is now more interested in variety and choice rather than exclusivity and exceptional quality. Since cost of quality of wood in India is very high, the company is reviewing the proposal for import of woods from the Nepali supplier. Exactly same language, nothing else. Maybe for that reason I might not have covered. The net Indian rupee Nepali currency cash flow nominal terms for this is shown below. These are the data point given. In that we had a 5 years data, I think this is 3 years data. Evaluates all investment by discount rate what? 9%. No challenge comes to you. All Nepali customer are invoiced in Nepali currency. Oh my god. Forward rate using discount rate, inflation rate in Nepal 9 and 8, Nepali currency assuming finance manager, NPV, and that question ended here, full stop. Actually I should have taken this rather than that question so that both could have been done. And modified IRR. And look at this, he has given this value. You know what is this value means? To calculate the future value. Now first part is the normal question what we do. What we did in the previous question was the rates, then we calculate what? Converted cash flows, interest in. So let me show you that numbers. When you go back home, what you can do is you can reopen this class and from here you can pick up data, you can practice on your own. I'll just show you the last part so that things becomes easier for you. The spot rate we know is 1 Nepali currency is 1.60. Estimation of ESR as per PPP, we can say ESR by SR. I applied the data points and I get first year rate as 1.615, second apply is 1.630, and third I'll get as 1.645. This I got. Then second step what we did was converted your Nepali cash flow into rupee and make sure Nepali currency would be on the what side? Left hand side. Left right will multiply. So we had these are our Nepali currencies 25, 2.6, 3.8 and 4.10. So these are in nominal. There is no concept of inflation given, so means it's a nominal and rate is also given nominal. So he is not increasing your workload at all. What we do is we convert Nepali currency cash flow. So Nepali currency cash flow we convert into rupee. So I'll show both these slides together. Nepali currency cash flows we convert to rupee. These are Nepali currency cash flows. Exchange rate we get in the rupee term. Then what I do is add rupee, converted cash flows which came from the top 1, 2, 3. We add them up, we get total. Exactly similar lines of the previous question what we did. And then we have present value factor at what rate? 9%, 0.917 in this. NP becomes negative. First part question ends here. This was not the objective, this you could have done easily. So basically calculation of the forward rates, estimated rates, and then convert the Nepali currency into the Indian rupee, and then accordingly you calculate the NPV. Modified IRR. Now what we do with the modified IRR? Let's look up this please. These are your cash flows now. 4.479, 6.530 and 6 point this. Now look at this. I have actually done in two formats. In exam do not show the line chart. Line charts I use so that student gets adaptable. Otherwise we do this way. So it's basically 4.479. I think these were the cash flows combined now. Yes. So 4.479 first year, 6.530, 7.090. Sir, 1, 2 and 3. How have I picked up? I picked up from here. Actually this shows me here. So it will be 1 rupee will remain. This will be 1 year and this will be 2 years. So I can get what value? I can get my terminal value. Terminal value comes 19.5277, or you can put in the format. That's one and the same thing. So first year end cash flow what you earn, you will get earning of 2 years. second year end cash flow you'll get earning of 1 year, and the last year is last year, and then you get what, 19.5277, and then we say at modified IRR. This is actually the presentation you can do in the exam after our part. At modified IRR, this is actually nothing but this is what kind of a compound amount. Compound amount divided by 1 plus r to the power how much? 3 should be equal to principal. In this word I'll say terminal value divided by 1 plus r to the power 3 should be equal to what? 15.625, and when I solve this I get r as 7.71. That's it. So there could be possibility this question was in the RTP, similar question came in the exam, I think 1 year back or 1.5 years back. They used only till the NPV, and after that if they want to increase the workload they'll give you add what? Modified IRR. Is that fine? So that was modified IRR. Let's take a 10 minutes break here and then we start off. Let's take a 10 minutes break and then we start off. Let's start. Let's come back, please. Let's look at another question from this topic, IFM, which has been regular visitor of your exams. Let's come back. Question number 2. It looks lengthy. It's a combination of a pure capital budgeting replacement decision plus this topic. So it's a combination of the two topics, you can say, a capital budgeting replacement decision plus international effect. Read once quickly. I'll just give you 2 minutes or so, and then I'll read out with you. If you want to read out before reading this question a replacement decision of the bond valuation, you can go back. Equal life bond replacement. We used to compare life at 0 period, then over the years, then end of the life. Exactly same way we'll have, and we used an incremental approach. Initial incremental cash outflow, then over the period inflow, and then at the end outflow. Exactly same way. That means either replacement decision is so very important. Either in capital budgeting he'll ask you, either he'll ask you in this level, or bond valuation. So one of the topics he'll ask you accordingly. So you can check this out. Question number 2, in which you can have a multinational company is planning to set up a subsidiary company in India. A multinational company is planning to set up a subsidiary company in India, where hitherto, that means earlier it was exporting. In view of the growing demand for its products and competition from other MNCs. The initial project cost consisting of plant machinery including installation is estimated to be 500 million. The net working capital requirements are estimated at $50. The company follows straight line method of depreciation. Presently, the company is exporting 2 million units. Now, keep highlighting the data point, please. The 50 million working capital is treated as outflow in the beginning, at the end inflow. So that's the capital budgeting concept. 50 million straight line method of depreciation. Presently the company is exporting 2 million units every year at a price of this. It's a historical data. As of now they're exporting 2 million. Selling price is 80. Its variable cost per unit being 40. The chief financial officer has estimated the following operating cost and other data in respect of the proposed project. Variable operating cost will be $20 per unit of production. Highlight this one, variable cost, so that when we put in the line chart, we are confirmed what data points will come. Additional cash fixed cost, highlight cash fixed cost, that means depreciation is not there, will be $30 million per annum. Project's share of allocated fixed cost. Allocated costs are irrelevant costs based on the principle of ability to share. It is as good as, for example, you have the capacity to share someone else's expenses. That does not mean that your decision making would change according to it. So basically allocated fixed cost is based on the principle of ability to share. It will have no meaning here. Production capacity of the proposed project in India will be 5 million units. That's basically he's talking about if he goes for the subsidiary. So new will be 5 million, earlier it was 2. Expected useful life of the proposed plant is 5 years with no salvage value. existing working capital for production sale of 2 million units through export was 15 million. That means it's old working capital. So when you have a new working capital, old working capital would be released, new working capital would be introduced. So 0 period we'll have that. Export of the product in the coming year. This is very important line. Highlight this please. Export in the coming year will decrease to 1.5 million units. Sir, we had 2 million. That means 2 million would be of no use. It means when you're comparing now forecasted, either you have 1.5 million of export or you do the production of what? 5 million. It is export of the product in the coming year will decrease to 1.5 million units in case the company does not open the subsidiary company in India in view of the presence competing MNC that are in the process of setting up their subsidiaries in India. Applicable tax rate 35, required return 12%, and there will be no repatriation etc., no withholding tax, NPV, and you have present value factors which comes out. Let me summarize what we have. 0 period we are starting is that we have existing working capital of 15 million. If we go to the new subsidiary, we'll release it. Then units are not 2 million now. Over the period 1.5, selling price 80, variable cost 40. At the end, we'll see what will happen now. Then in the new, the cost of the installation is 500 million. Working capital, first paragraph given how much? 50 million. Units will be 5 million. Nothing said about the selling price. I think selling price will remain same. Will be a 80 only. Variable cost 20. Depreciation would come and additional cash cost will come. Allocated expenses are irrelevant for decision making. That does not impact your decision. You have the capacity to share. That means you can share someone else's expenses. And then we have the sixth point was important, in which you were as of now standing at 2 million, but now it will shift to what? 1.5. That is the relevant data which comes out. So line chart I'll show you, and then I'll ask you 2 minutes time. Draw for me line chart. I'll show you, and then I would expect you to do the working for me using that line chart. This is question number 2. This is my data. We have release of working capital, export what we have, and then 0 period 15 million units 1.5, selling price $80 per unit, variable cost. Subsidiary if I go, the important point changing is this 1.5, this 5 million, 20 dollar 100 million cash cost here, and then salvage value is nil. Working capital we have at the end of the years. So read it carefully please. 0 period what will happen? 0 period would be new cost involved. 0 period would be new cost involved, new working capital, this will release. Then over the period calculate CFAT. At the end this working capital would be released, or earlier you were able to release this. Salvage value is 0. Roughly take 2 minutes time. In let's suppose 0 period I am standing. What will I do in 0 period? 500 million my costing, 50 million my costing of new, and 15 million will come release of old working capital. What is my 0 period? 535. Over the year, now calculate over the year please. Over the year, let's do it verbally. Old, let's do it. Selling price what? 80. Variable cost 40. So net we get is what? 40. 40 into 1.5, 60 million. Then tax rate do we have? 35. How much? 39. That is your no depreciation. Na? 39 is CFAT. Let's do it. 80 minus 20. Two ways you can do. You can keep multiplying by the units and then calculate, or I am doing simply per unit. 80 minus 20, 60, 60 into 5, 300, minus depreciation, 100, minus this 30 cash cost, how much? 170. Then 35 is tax, balance would be 110.5. This is your PAT. It's not CFAT. Add back depreciation 100. Add back depreciation 100. How much do we get? 2 10 point something. So difference of 2 10 point something minus the earlier 39 171.5. This will be your over the years. Then last year would be in the new you will be releasing how much working capital? 50. In the old you were releasing how much working capital? 15. How much will come? 35. And then you can calculate the NPV. So look at the data I have. So what I said was, if I show you my data points, but full screen I'll show you. Look at the data points please. So 0 period I had left side. Initial incremental cash outflow 535. Annual incremental cash inflow, I have taken the full figures here. You have taken the manually and you calculated same I think. The 39 and new was 210.5. Difference of them is 171.5. So incremental CFAT we have 171.5. The release of working capital, incremental working capital, new will release 50. If new was not there, old would have released what? 15. So net comes what? 35. And then you do what? Calculation of NPV. That NPV comes out. So quickly check the answer of first part and then second part. I'll just include the first part and the second part. Initial incremental cash outflow is 535. Annual incremental cash inflow would be 171.5. Sale of old, new, fixed cash cost, depreciation, PBT, PAT, depreciation, CFAT we get, and then would come, if I try, incremental working capital and NPV. I think discounting factors he gave it to you. This is one of the common repeated questions in the exam. Once you're done, let me know. We'll move to one of the interesting questions after this. Done? Done. Let's look at question number 15. Slight problem could be there in the data or understanding. 15th. Read once quickly, please. Let me read out data with you. It says the proposed foreign investment involves creation of a plant with additional annual output of 1 million units. The entire production will be exported at a selling price of $10 per unit. At the current rate of exchange, dollar cost of now. Keep looking at the proposed investment, creation of plant, annual output 1 million units, selling price of USD 10. It is the data given. Which country we do not know. We do not know about the countries and so on. At the current rate of exchange, dollar cost of local production equals to 6 per unit. So I can make out 10 million units. Let me put as 10 lakh. So I can make out that 6 and 10. What is my profit here? 4. Just give me a minute's time, please. Let's look at the data, please. Come back. It says a proposed foreign investment involves creation of a plant with annual output of 1 million units. I am just putting in 10 lakhs. Entire production will be exported at a selling price of 10 per unit. He is not talking about which country. At current rate of exchange of dollar cost of local production equals to $6 per unit. That means my profit as of now is what? 4. At current rate of dollar is expected to decline by 10 or 15. Again, he is not talking with respect to what country. Maybe that is irrelevant also. It's okay, fine. The change in the local cost of production and probability from the expected current level will be as follows. Now what he says is decline in value of USD 0, reduction in the local cost of production nothing, that means your production cost would be 6, probability is 0.4. It means, can I say my profit would be equal to what? 4. My profit will be equal to 4 rupees, $4 per unit. If USD value declines in 10%, that's 10% here I'm reading, and reduction in the local cost of production in USD per unit, $6 will decline to what? 5.7. Probability is what? 40. Any change in the selling price? No, nothing given. That means 10 minus 5.7, how much do we get? 4.3. If dollar value declines by 15, 15.15 additional reduction, that means 5.75 will become what? 5.55, and my profit would be 4.45. You may assume that, sir, which country currency is talking about, we is not given, maybe that is irrelevant. Problem in the data was, which I think should be a problem, but anyhow when the exam comes, do exactly the same way. From here we can make out selling price, cost at 3 levels. Basically these are scenarios. I don't know whether in the scenario analysis you've done. Final we'll see that. I think scenario analysis, different type of scenarios comes, that one case, second case, third case. So these are 3 different scenarios in which costing will change and accordingly my profit will change. The problem was, I think this line, highlight this line. Maybe till the time your institute does not change anything, keep this way. Otherwise we might have some adjustment which I think could be there. The plant at the current rate of exchange, actually this wording was current rate of exchange, will have depreciation of USD 1 million, which is equal to what? 10 lakhs. Now what he has done, I'll use the same way, and could be a possibility. What he has done is, at current exchange rate 10 million, when the exchange rate declines by 10, this will become what? This also declined by 10%, it becomes 9 lakh. Actually with the change, depreciation is on historical cost, ideally should not have been changing, I don't know why, but could have been possibility, maybe with the reduction in the USD value there could have been some change in the capex and according depreciation. So what they have assumed is linearly decline in the depreciation along with the way value of the USD is declining. So it becomes 9, and when 15% decline comes, the depreciation would be taken as what? 8.5. You are required to find out annual CFAT under 3 different scenarios. Do not what I'll do is I'll do one with you, then I'll show you the second, both the answers, what would be there. So let's cover the first part. Let's do the first part here. What will be done? Units are equal to what? 10 lakh units. You can do along with me so that second, third becomes easier for you. Units are 10 lakh. Selling price, first case is 10. Cost per unit 6. First case we are taking, first case. So my profit would be equal to $4, and total profit would come. Total profit would be 4 into 10 lakh. How much? 40 lakhs. Total would be 40 lakhs. Depreciation 10 lakh. First case we are taking. So second case depreciation will be what? 9 lakh. Depreciation 10 lakh. Then PBT 30 lakhs. Tax what rate? Given somewhere, no? Given local tax 30. Now again he's saying local, but he's not mentioned the currency. It's okay. Whatever data you have, you can do the same way. How much will it be? 9 lakh. My PAT would come what? 21 lakhs. And then you can do what? Add what? Depreciation. So depreciation is 10 lakh. 30. Second time also when this question comes, do exactly the same way please. 31 lakh. Now can you calculate the second and third subsequent? Sir, what we'll do, in the second scenario your profit will be 4.3, depreciation would be 9 lakh. And third scenario, your profit would be 4.45 and depreciation would be, calculate the CFAT. Calculate the CFAT, please. $32 lakh, 80,000 or 70. 32 lakh, 80,000. Third one, 33 lakh, 70,000. First party asked, calculate what? All three scenarios expected cash flows. So this is my first part answer. I hope in between you can do it. I'm assuming can be done. Yes. Second part he asked was expected value of CFAT assuming no repatriation of profit. Sir, what's the difference in first and second? First also expected, second also expected. You know what he means? Second part basically multiply by what? Probability. Second part multiply by probability. That means what you will do is probable cash flows. That means into 0.4, this chance is 0.4, this is 0.2. You'll get something. Net, you can tell me what comes. This is your expected CFAT, because I think you would have done probable cash flows. Now this is kind of probable cash flow. 32 lakh 26,000. Highlight that depreciation part and highlight that reduction part. That was important. Third part also will speak out. Third part. Once you've done this, let me know. Done? Can I move? Yes. Now let's read what is he asking in third part. Actually, it's a capital busting. It's only because dollar is given, I've taken it here. It's a capital busting. Viability of the investment proposal assuming initial investment of dollar what? 25 million. That's your 0 period investment. Working capital will and working capital, that means 25 million includes both of them, with required rate of return on 11%, and on the basis of CFAT arrived under option 2, CFAT will grow 3% in perpetuity. So basically you have to calculate perpetual value of inflow. Cash inflow will be 32 lakh. This will go in perpetuity. So using this you will calculate your perpetual value minus 25 million is as good as 2 crore 50 lakh. I think 25 million, 1 million has 6 zeros. So 2 crore 50 lakh minus 2 crore 50 lakh you'll get. Now problem is you tell me what is my perpetual value. How do you calculate? Just now calculated Nalayak African question. Perpetuity value. Growth is also given here. Huh? Expected cash flow. Formula is expected cash flow divided by K minus G. Should I multiply into 1 plus G? Why no? Expected. Now let me show you the institute answer. That's what I was. That is the reason of covering. So these questions come next time, na? My expectation from you would be what I would, this is question number 15, na? Yes, 15. This answer you got, na? Exactly same answers you got. You got 31 lakh, 3280 and 3370. This we were same here. Then you got expected value 3226. No doubt on that? No doubt. Then next part, actually this word is expected cash flow. What answer they gave was multiplied 1.03, which I think is not required, because expected means already includes a growth. Formula should be this divided by 0.11 divided by 0.03. Basically, how do you use? Generally, you use d0 into 1 plus g divided by k minus d. If d1 is given, then d1 divided by only what? K minus d. So this would be the modified answer, I think, next time when the question comes in. So by chance, if you look at the answer, they might have given into 1.03 on the numerator. 1.03 is not required. If you fail unsafe, then give both or. The problem is this is not required. This is expected. How can you have expected again add the growth? Because that is already added. Perpetual will be this divided by ko minus g. So whenever you have expected, it's expected cash flow divided by K or K minus G. So the answer would come as 3226, which you got, divided by this. These are your perpetual cash inflow minus your initial outflow. Although in both cases, the NPV is coming as positive only. Quickly check that out, please. Once you've done this, let me know. Just mark the third part answer so that you know what the third part answer is coming as. When you cross check home. Done. Now moving to a concept in which question was asked, although that adjusted present value concept used to be there in capital budgeting. After that, I think they mentioned in some other chapter, maybe a portfolio somewhere. And now capital budgeting has been reintroduced, so this becomes anyhow the important topic. I have put it here because maybe because of the dollars. Coming back just to explain you, if someone knows, it's okay. If you would have done the regular or any classes, you would be knowing it. Otherwise, you could have done somewhere else. Anyhow, if you have not done, then I'll do it with you. It's not a tough concept. The concept is adjusted present value or adjusted NPV. Adjusted present value, adjusted NPV. Why the objective comes in? The objective of this topic comes in under this concept. Will take into account financing aspect of capital budgeting. That means I'll segregate equity financing with the debt financing. The reason being, there could be a possibility, whatever question you've done till now, anywhere now, you have only one discount rate, you discount by that rate. You have never seen a problem in which question comes in that project is 10-year life and the debt is only 6 years. Project is 20 years, debt is 15 years. You cannot have a KO because 15 years and the mismatch of the year comes. That means we segregate. The objective of the debt actually is, the objective of debt is to take the tax saving on the interest. Otherwise, for example, whatever money I raise, for example, I spend 300 crores. Whether I spend by equity 300 or whether I spend by debt equity, the cash outflow in the zero period is 300 crores. The objective is, let's suppose I have 200 crores of equity, 100 crores of debt, project life would be 10 years, but debt would be only for 4 years. Then how do I discount by this same KO? KO cannot be for 10 years because the debt will remain only for 4 years. In those kind of a project, we segregate equity and debt financing. I'll assume as if the entire project is from the equity, and then I'll take only the tax benefit of the debt part, and accordingly I'll know. So few advantages of this method are, one is the difference of the time period of equity and debt you have. Second is, when you apply a KO as a discounting rate, let's suppose, there could be possibility you find KO as weighted average cost, KE into weight of equity plus KD into weight of debt. KD you calculate is applying the into 1 minus D. What if the tax rate changes in the economy? For example, your finance minister comes and says over the next few years, our tax rate, which is standing at 25%, will decline in the next 5 years to 20. So if I am doing my projection, this is 25, then 24, 23, 22. How do I calculate that KO? So what I do is, in the tax effect, I can show interest component tax benefit of 25, interest component tax benefit of 20. I can adjust easily. So there could be this kind of scenario. Third important part, which is technically very important, is when I'm raising money from the debt, I go to the debt holders. They refuse money. I come back home, I see, let me see my own money. If with my own money project is coming positive, then there is no need to go to debt holders. Or even if you want to take debt to increase the value of your equity shareholders, you do not have to bend down so much to their terms, because you know, even if I do not take debt money, my project is still viable. But if my project is unviable, then certainly I might have to agree upon their term. If my project is viable, then I will go to the extent possible wherever the debt can increase my value to the equity holders. So this concept comes helping hand at few places. Otherwise, generally we will find only one discount rate capital budgeting. You will do it. This is practically is used in certain circumstances where you want to segregate and want to see that my debt equity financing would be a different time period. Let me see, because the cash outflow 0 period is cash outflow. That's it. The debt financing only objective is the tax benefit, nothing else. So what we do is we take the calculate NPV in such a way, all equity financing, and then we adjust for the tax benefit of the interest component. That's it. Sir, what about the loan which we take? There is no problem with the loan we take, because the outflow I divide in 0 period. So whether I write 300 crores, I write 300 crores only, whether it is debt equity plus or only equity plus, it does not make a difference. Let me read out how the question came, and very nicely framed question came, which came in the exam, which actually proved the objective of APV, that question which came in exam. Under this concept, we will take into account the financing aspect in capital budgeting. Base case NPV, first step we calculate is base case NPV. That base case NPV is calculated on assumption that entire project is financed from equity. Hence, discount rate to be used should be KE. That means since you are finding the equity value, you take only the KE. Calculate tax benefit on interest, since interest saves tax. Now, since you are calculating the interest tax benefit, you have to bring it back to what period? 0 period. Discounting would be done by the interest rate. PV of tax shield on interest. Discount rate to be calculated, discounted to be used to calculate PV should be the interest rate. The KE would be for the cash flows of equity. Since you are discounting the interest rate, interest tax benefit, this will be discounting by the interest rate. Apple to apple comparison. If any flotation cost is given, then it should also be adjusted. Adjusted NPV is base case NPV plus present value of tax shield on interest. The objective is interest only gives you this tax benefit, minus any flotation cost is there added. I have taken a small example on the same page. Initial investment is 50 million. Annual CFAT 10 million forever. That means every year I'll get 10 million forever. Cost of equity 16.5. Interest amount per annum is 2 million perpetual. Interest rate 8%, tax 40. Calculate the APV. Now I am assuming sir, how much is the debt amount? Debt amount is irrelevant for me. Initial investment could have been debt equity plus both, but this is irrelevant because my initial outflow would be 50 million only. Annual CFAT 10 million. Discount, since there is no growth, 10 million divided by 16.5 minus 50 million outflow. That means my base case NPV comes what? 10.61. Is the project viable? Yes. That means I know from the home when I am going for the debt negotiation, my project is viable. If the debt financing comes as per my terms, it's okay. If they do not come, still I am okay. So decision when we write, I'll dictate the decision. Don't worry how exactly I write. My project is viable. Now I'm seeing with the debt financing what can happen. How much is my interest amount every year? 2 million. When I debit to my income statement, it will save tax of what? 40%. How much every year saving? 2 into 40 is my tax saving. 2 into 40 is my tax saving. How much it comes? 0.8. Divide by the interest rate. This is my perpetual tax saving. That means if I get tax also included in me, my value of the NPV, which is coming 10.61 only with the equity financing, can increase to 20.61. Understand the objective. Sir, what about the loan? Even if I would have taken the loan, let's suppose the 50 million outflow would remain 50 million only. It's only, I'm assuming, if all equity and debt component only would save what? Tax. That is the present value tax shield. Although your institute, I think, gave one more alternative, but this is the alternative which has to be used. This is exactly because the objective of debt is saving of the tax which comes out. Now decision, write down. How do you write the decision? It's not the normal way we write the decision. Put down please. Project is viable. Project is viable. Project is viable with only equity financing. Project is viable with only equity financing. But if the debt is taken, project is viable with only equity financing. But if the debt is taken, then tax shield on the interest. Then tax shield on the interest. Then tax shield on the interest will increase NPV. Sir, what are the basic advantages? Basic advantages could be, for example, you cannot segregate debt equity in a normal KO. If the life of the project is some year and debt is for some year, you cannot segregate in the normal, because in normal case you have only cash flows and one single discount rate. This helps you in segregation of that. That means as of now I have taken the complete term. The question which I'll cover, it could possibility I'll have cash flow for 20 years, debt is only for 10 years. That means I can take tax benefit only for how many years? 10 years. This will adjust. The normal capital budgeting cannot do. Another point, let me go back to the inter class. Inter again, yes. Basics of inter I cover. I don't know you cover or do not cover. In that class only I cover, I think. What is the advantage of depreciation? Yes. First sentence only I do. When CFAT I do. This will come handy now. When I do CFAT, it's PAT plus depreciation. After that, generally teachers would do, or they would do at some other place, PBDT minus depreciation, PBT minus tax plus depreciation and get CFAT. Or part you do is, I do not subtract depreciation. What is the objective of subtracting depreciation and then adding back? Only tax saving now. Can I do this way? PBDT less tax, it is called PAT BD, profit after tax before depreciation, and then take directly tax saving on what? Depreciation. Can we do? We'll get exactly same CFAT. By chance I used to do this in the inter, some questions used to come. I never expected final also they'll give the question on this. Final also the question came which is based on this parameter, so you should be comfortable. The objective of depreciation is only to save tax which comes out. Let's come back to our finals. The question which beautifully framed, very rare time we have, but by chance they gave two answers which reduced the impact of the question, otherwise question was beautifully framed. And this I've been covering ever since I started teaching. In fact, one time this question was asked in the inter also. It is not part of the inter, but I don't know why they asked a long time. A very weird question came in there. Let's read this question once quickly. The management of a multinational company TL Limited. Could you read it out once? I'll show you so that working also I can read out once. 14th question. Mark it as important, please. Since now capital budgeting has been reintroduced, So this becomes ultra important now. This is question number what? 14. Very good. This came when, sir? November 20. We have the management of multinational company TL Limited is engaged in construction of an infrastructure project. A proposal to construct a toll road in Nepal is under consideration of the management. The following information is available. Initial investment will be purchase of equipment of 250 lakhs. Now he is saying initial investment of 250 lakh. It is immaterial debt, equity, or combination of both. The economic life of the project is 10 year. Highlight. Economic life of the project is 10 years. That means depreciation would be for how many years? 10 years generally, if you apply the accounting principles. The depreciation on the equipment will be charged on the straight line method. So 250 divided by 10, something would come. EBITDA, earning before interest, depreciation, tax, and even I forget when I read that term. Practically we use what? EBITDA. EBITDA, earning before interest. How do we write? I used to write, means after doing so much EBITDA, this is right, na? EBITDA is okay. EBITDA only we write, na? Earning before interest, tax, depreciation. How do I write EBITDA? Yeah, just wait, na like. EBI TDA. D last one, but that is one and the same thing. Still they have right. EBITDA is not written. Just Google it. EBITDA spelling is this only, or you see? No, EBITDA spelling na like, just see one. It should be TD, na, earning before interest tax. This term I don't know when they'll. It's anyhow they've written EBI DTA. It's okay. EBITDA should be EBI TDA, na. Practically this term. I think I would have told you in the M&A also. Anyhow, objective is same. EBITDA, because is 33 lakhs for a period of how many years? 20 years. Now there are two ways. You can do two ways. 10-year EBITDA, 10-year depreciation, calculate your CFAT, or 20-year EBITDA, segregate, depreciation will say what? Tax, segregate. You got the point, the objective? To encourage, this line was important, to encourage investment, Nepali government is offering 15-year term loan. Loan is for how many years now? 15, for USD 150 lakh at interest rate of 6%. Now this might not be the interest rate of discounting, because to encourage investment they might be giving you at a cheaper rate of interest. Your costing is coming at what? 6% interest. The interest is paid annually. Loan will be repaid at the end of the 15-year in one tranche. Your institute might have shown something alternative, but we will not do anything with the loan. Objective is interest will save tax. The required rate of return for project under all equity financing is what? 12% per annum. Pre-tax cost of debt is 5.6 per annum. Corporate tax is 80. So if 5.6 is there, when I reverse calculate interest rate, it comes 8%. But sir, you are getting loan at what? 6. I am getting loan at 6 because Nepal government wants to encourage the policy of investment, hence they are giving it cheaper. Your discounting rate would be 8%, and you will come to know from where, you know, from where I told you in some question earlier also. How do you come to know discount rate would be 8%? When you look at the present value factors, na, you'll come to know the hint. You'll come to know the hint that 8% is coming, and equity is what rate? 12%. So if doubt comes, na, sometime look at that. Next time I don't know if this examiner also becomes smart enough. He gives you more alternate rates. So discounting rate would be this. All cash flows will be in the USD. Ignore inflation. You are required to advise management of viability using adjusted NPV. In fact, this could have been done using adjusted NPV only because the life of the company is how many years? 20, and you have the depreciation is not the problem. Problem is the loan. Now let's verbally do it. Let's 33 million EBITDA, no depreciation, no interest, assuming all cash flows are from what? Equity. Verbally do it please. 33 million minus tax what rate? Where is gone 30%? 30% tax. You get what? PAT BD. Multiply by how many years? Be careful please. Project life is what? EBITDA is for how many years? 20 years. Multiply by 20. How much do we get? How much was PAT? 23.1 and 20 years 7.469. How much you get? Present value of PAT BD? No, like nothing. 33 million you have. 33 million into 0.7 is profit after tax before depreciation. This will come for how many years? 20 years. So 20 years discounting multiply by annuity factor of how many years? 20. Sir, why this 10 is given then? You know 10 is given for what? For depreciation. So into 20, how much you get? 172.53. I'll just show you. Do not copy. I'll give you the time to copy also. Its present value comes 172.53. Depreciation, look at the question. How much? 25 every year. It will save tax of what? 30%, 7.5. For how many years? 10, 5.6. How much present value of tax saving? 50. So if there was no debt, my base case NPV would be equal to what, sir? My base case NPV would be this present value plus what? Present value of tax saving on depreciation minus outflow. How much? 250. It's present value of cash inflow minus this. So my base case NPV is negative. It means if I go only for equity financing, it will give me the negative answer which comes out. Now second part, tell me how much interest you will be bearing. How much interest? Loan amount is what? 150 lakh. How much interest cost? How much interest? 9 lakhs. How much tax saving? 2.7. How many years? 15 years. Rate of discounting would be careful on that, not 6%. What is the practical rate appearing in the market? 8%. 2.7 into that annuity factor of, in the book it is given, annuity factor of 8, 23.109. So basically if I look at this part here, present value of tax saving on interest, loan amount 150, cost 6%, interest amount 9 lakh, life 15 years I have. So present value of tax saving on the interest is 23 point this, and base case NPV was 35 negative. This my project is what? Negative. APV is negative, should not be accept the project. Question was not tough, but if you do not know first time it can challenge. And I was surprised to see language was nicely framed, question was framed, and best part was what is technically should be given, they gave the answer. If they would have given alternative, which I think when you go back home, I think they have taken loan in 0 and then maturity, etc. That is not the objective, because our objective is the interest save tax, and that is what the objective of this APV is. And it is able to do this calculation only when it is 15 years, where the entire life is what? 20 years, which comes out. So next time I'm assuming there could be very high chance they'll repeat the question. So if you want to copy anything, you can copy from here. The base case NPV, you can make it out. Let's just do the screen. If you want to take a photo, you can take a photo. If you want to copy, you can copy, whatever way you want to do. Different of years. Actually, no, he will not identify this problem anymore. He'll mention it out. But if there is a difference of years, then certainly you cannot do normal KO discounting. How will you do by normal KO? Because if the life is only for, let's suppose the interest rate is for 6 years and project is for 12 years, how would you solve that project? And that is why he says gave the APV. He wanted to reflect the advantage of APV also by using this question. Depreciation he might have given 20 years also, it does not make a difference. But especially when the capital budgeting has been reintroduced, this becomes important now. And I think earlier it was given in capital budgeting, then it went off, then it was given part of the portfolio management, if I'm not mistaken. Or maybe IFM, I don't know. Because I have been doing ever since I started teaching this concept. Once you've done, let me know. So first part is base case NPV, and second part then we have is the loan will save tax. Interest would be saved. It's a present value of tax saving on the interest. Loan amount 156%, interest amount $9 lakh, term 15 years, and 9 lakh into 30 you save 2.7 lakh. Present value of tax saving on the interest will be, sir, how did you get 8%? 8% we got 5.6 was your after cost after tax divided by 0.7, we got 8% as rate, and then multiply by the annuity of 15 years, you get this. Base case NPV we got from here, it was 35 this lakh, and including this still your project is unviable, minus it comes. APV is negative, should not accept the project. If by chance depreciation was also 20, now things could have been slightly simpler. You could have taken along with the EBITDA only. These things could have been slightly simpler, but depreciation calculation is shown separately. Depreciation objective was to save tax, and similar was the tax saving on the interest. Done? That's your adjusted present value. I think we have covered everything from here. Yes. That's it. We finish IFM. We'll wind up here. Take care and bye bye.